HQ only. Year to date, but they've missed the 2025 estimates that analysts have previously been penciling in. So we'll watch that and watch the chip story around that Nvidia report in the FT. We'll see if we get any movement there, Guy.
Absolutely. Okay, here we go. Market open this Thursday morning. As I say, don't expect fireworks. Let's show you some numbers. The opening trade is upon us. I give you a drum roll, but it's a very limited one. FTSE 100 doesn't know what to do. It's in and out of positive, negative territory. Nothing to see there. The IBEX comes out of the gate absolutely flat. Look at that, unchanged. Nothing going on there. The stock 600 is up by a whopping 0.01%, folks. This is an exciting market open. I'm struggling maybe to provide you with something useful to take away from all of this. At the moment, basically, I think the market's sitting on its hands. We've got through one volatility event. That was the Fed. Is this an indication maybe that Powell did what he hoped maybe he would do, which was leave the market reasonably unmoved by his actions? Well, if that was the case, then Europe is certainly giving him a big tick in the box on that one. We have got nothing here. Anna, save me with some sectors and some single stock stories.
Well, I'll do my best. I'm not sure I can oblige. Let's talk about the sectors story, shall we? So food, beverage and tobacco is the best performing sector this morning. So that doesn't sound all that cyclical, does it? So that's the best performer. That's up around 0.5%. But we do have around 2/3 of sectors in positive territory. Futures have been suggesting we'd be pretty flat. We are pretty flat. One of the movers to the downside I see, though, is Compass Group, and that, of course, competes with Sodexo. So there does seem to be some movement coming through in the companies that supply catering services, and that warning about the United States. We'll see how far that travels. Does that stay within the catering sector, or does that go elsewhere? But Compass Group is down by 3.6% this morning. So that's what we're seeing there in terms of the sector's picture.
Tech is up. So maybe we did call that one a little bit correctly. SAP, in terms of points, is adding the most this morning. It is up by 1.1%. ASML is up by 0.9%. But elsewhere, the sector story, I think, as you say, indicating quite a lot of mixed views in the market this morning. In terms of the breadth and what we're seeing this morning, you've got 362 stocks up. You've got 207 that are down. So on balance, maybe slightly positive. The market is up by 0.04% when it comes to the stock 600. quarter, so maybe slightly positive, but I'm not sure there's anything clear that you can discern in terms of what we can take away from that. I checked my sheets on what is happening with the 52-week highs and 52-week lows. There's a few out there. The banking sector is delivering a few, but there aren't as many as I would normally see on this board. And yeah, you've got a couple of banks. Heidelberg is up a little bit. Technip is up a little bit. Aviva, actually, in the insurance sector, there's a few. But elsewhere, again, I struggle to provide anything concrete to put out there.
Yeah, and there is that movement on Compass. I was just looking at Sodexo. That is actually halted. So there does seem as if there's some downside movement in the catering sector.
Catering is our sector this morning.
It is our sector this morning. I mean, everyone needs breakfast, Guy, and it's just gone 8 o'clock here in London. So this feels incredibly appropriate to the time of day. Lanxess was the other one we mentioned actually ahead of the open. So credit to the team there because that one is down by 2.8% this morning. So we have found some interesting themes and stories to trade around. But the biggest move actually on 3i in London. This is on the Stock 600 and Process. Both of those down by more than 3.5%. Let us, though, put to one side the movement we're seeing in markets, such as it is this morning, because there isn't a huge amount of it. And let's instead focus on what we heard from the Fed, how investors are responding to the Fed, and what that means from here. Let's listen to how some guests on Bloomberg TV have been reacting to the latest commentary from the Federal Reserve.
Think if you're in corporate America and you hear that, what do? You stop spending and you hold all the capital you can. This is a very dovish Fed.
I think this was much more hawkish, and the Fed not quite going to one rate cut, but the number of people who are expecting one rate or less cut this year going up. That gives you that sense of the dispersion of risk and the challenge of corralling the cats in a very uncertain environment.
There's kind of clear elements of both of these here. I think the market's view is it's not as hawkish as was anticipated. I think there was a fear of a median of one rate cut for today, and so far at least that fear was alleviated.
The market is rallying today because this was not as hawkish as it could have been. I think the risk coming into this was maybe we just saw one cut in 2025. We kept the two. But going forward, I think we should be baking in some widening in credit spreads, and we would view that as an opportunity.
So it was dovish, it was hawkish, it just wasn't as hawkish as expected. Many views there. Takes many to make a market, of course. Let's talk to Madeline Ronner, Global Equities Portfolio Manager at DWS. Madeline, nice to have you with us. What does any of that mean then for your allocation, or your allocation to the United States versus other geographies, your sectoral allocation? Anything you heard yesterday that moves the dial for you?
Thank you for having me. So actually, I think yesterday we didn't get too many news. I think it was very much still the expectations that we will see roughly 50 points cuts this year. I think this is what he delivered. I think he managed it very well to calm markets a little bit in this very uncertain environment to see either way how tariffs are going. We have the situation handled. Yes, there was some, I think, worse messaging probably on the growth picture. So I've also heard some thoughts about stagnation probably being thrown around again, which could be more on the negative side. But generally, I would say this was not needle moving for our positioning.
Okay, and how much are you seeing money moving into Europe, given what we're seeing in the United States with tariffs, given what we're seeing with fiscal expansion in Europe? How do you characterize it? Because some people are saying what we've seen so far on European gains is just people closing shorts and turning a little bit less negative than they were. We haven't yet necessarily seen the next leg of gains. How would you characterize what we're seeing in Europe, Madeline?
Yeah, so I mean, for sure, going into the year, generally Europe was an underweight for many active funds and investors generally. And that has started to shift a little bit with the growth picture in the US being a little bit more dampened, and the growth picture in Europe actually picking up. However, we still like Europe structurally. We had an overweight going into the year, and we're keeping that. But tactically, for the next few months, I think the market currently is a little bit underappreciating the risk when the tariffs come to Europe, when Trump's focus on tariffs come to Europe. I think there is a risk of this escalating, which I don't think is priced in markets. And let's also not forget that a lot of European companies make a lot of profits in the US, and the European economy, despite all of the fiscal stimulus, is still very much dependent on what the US does. So if the US growth just slows, I think the fiscal package can really help to accelerate growth and make Europe more attractive again structurally. However, if the recession risks obviously in the US have increased, and if that were to happen, I think it's very hard to get a positive picture on Europe as well. So it's a little bit mixed right now, but longer term, this is really the fiscal policy shift is really, really historic. So there is a lot to get excited about in Europe.
So, Madeleine, do I buy dips in Europe if I see them?
Depends on the scale of the dip, but generally I would say yes. I mean, if you look at the valuation gap to the US is still on historic highs. It has closed marginally, but not by much. But if you look at the valuations, for example, in the German DAX against its own history, it's not that cheap anymore. So, but obviously, earnings estimates might be revisioned positively as well. So, if you see some dips on trade policy, which I hope at least will not be permanent, then I think this could be again buying or entry opportunities into a structurally more attractive market. Because let's not forget also in Europe, the consumer generally is quite healthy, right? The consumer balance sheet, it has been more consumer confidence and the willingness to spend that has held growth back, right? It's a different picture in the US. There the consumer is much more stretched also from a balance sheet perspective. So if we can really start to get this going, I think Europe does have a lot of potential.
Have there been sectors in Europe that you think have become far too stretched? Defence is the one that instantly springs to mind. The market has really focused on that defence story, and I'm wondering if that is where the risk really lies, that the reality of what Europe can do on the defence front maybe is overpriced into some of these key areas.
So I think the first thing I would say, I would caution on the valuation side to look at like 12 months or 20 months forward earnings and PE ratios. I think that can be misleading because for once the earnings estimates have not been caught up yet. So you need to do your own work on what you think the earnings power can be for those companies. And I really think the market is currently focusing more on the structural opportunities. So what is the earnings power in 2030, 2035? And then you need to discount that back. And I think for that, there is a lot of potential here. However, as you mentioned, like one of the large problems right now is capacity. Like how fast can you ramp this up? And I mean, Rheinmetall talking about repurposing VW plants is showing this this problem quite nicely. And there might be some ways to do that, but that might be where the market could be a little bit disappointed on how fast this goes, because defense and infrastructure spending also on the fiscal package, let's not forget, that takes some time until it works, right? So we are not expecting a large shift to growth this year. We expect like the first incremental points of GDP growth, like 0.5% to start next year from that package, but it will take some time until this really gets going.
Yeah, Madeleine, I wonder what's priced into markets. Is it possible to say at all what's priced into markets when it comes to tariffs? I'm thinking of Europe and what kind of reaction function we'll see in stocks when we see the facts around these tariffs. Of course, we'll see percentage tariffs, we'll see what they're applied to, we'll work out what percentage of the economy, which companies are affected. All of that will have to be done. But do you have a sense of what we're assuming already, so that when we see the numbers, we'll have a sense of whether this is good or bad news versus expectation?
So I think if it only comes into place what is currently announced, that looks to be fairly expected and priced in, and would not be it would be a drag to growth, but it would be like a huge disastrous thing. However, I think the real risk really lies that this escalates, and we've seen how erratic it has now kind of happened with Canada and Mexico. So I think there's really a risk that if the EU retaliates, that Trump kind of over-exaggerates on some retaliatory measures on the US side. So, and I really think if that happens, that obviously is not priced, and there is little risk priced into that and to the markets right now. So that would be my main focus. So if we will see some kind of stabilization starting out of April, and I think markets will need some kind of 1 or 2 months or 3 months even of that to be stable, to believe it, that really nothing is going to happen afterwards. But I think that's kind of unlikely. I think we will see kind of a back and forth, and we'll really have to see on how it goes and on the spot. So uncertain right now, it's very hard to tell.
Madeleine, great to catch up. Yeah, uncertainty seems to be the phrase or the word that everybody is using right now. Madeleine Runner, DWS Global Equities Portfolio Manager, thank you very much indeed. Core 6 looks like this. Little bit of a bid, maybe into some of the technology stocks that we've been watching this morning. As you can see, ASML is up by 1.3%. Elsewhere, a very, very mixed picture out of Europe this morning. No clear sense of direction. So let's dive into something that is at least on the menu, and that is what is happening with the food stocks. Joe.
So catering stocks, Guy, really the sector in focus today. Take a look at Sodexo over in Paris. We're down around 13% on that stock. The company warning of weakness in North America, specifically in the healthcare and education sectors, two of the key sectors that they supply to. And this is interesting to me because yesterday we had a downgrade for Compass by Exane analysts. They warned of exactly that, weakness in the US in those sectors. One stock that I think is interesting, also dropping, Pearson, the education company focused on the US, an interesting read across from that, given the warning around that sector. Then in terms of chemicals, that was looking a little bit weaker as well. The numbers out of Lanxess, that was the old spin out of BASF, or actually I may be getting my Bayers and BASFs, I'll have to check that one up, but it was a spin-off from one of the old German companies, and that stock weaker today and actually feeding through into some of the other chemicals companies, but only down around 5%, not as bad as the catering issues on that one. Then in terms of the financials, Prudential, that one a bit stronger. We did have results out of the insurance company over in the Asia trading overnight, but listed in London, of course, it is doing well on life insurance according to the firm there. Then there was a second day reaction for Prosus. Now we had 10-cent numbers hit yesterday. Initially a strong reaction for the Dutch listed stock that is the biggest investor in the company, but overnight the sentiment soured on Tencent, and that feeding through into Prosus this morning. We can see that down as much as 3.7% this morning. Then Covent Garden in the headlines because Shaftesbury Capital doing a big deal, $2.5 billion, potentially £billion in terms of a deal on selling a stake in that, a 25% stake in Covent Garden, with that big valuation coming through for the asset there. 13% gain for Shaftesbury today in London. And finally, on the ratings changes, Lloyds is upgraded at HSBC. Now, they've been hold rated for 4 years. Since 2020, they've had a hold rating. Finally, they say it's time to buy Lloyds, given the company seeing better than expected returns. And that one outperforming very slightly in London. Lloyds only up 0.2% today in a pretty calm market this morning.
Joe, thank you very much. Joe Easton from our equities team. So catering companies, the story in town this morning. How many ways are we going to find to talk about that in the next 45 minutes, do you think? How many more puns on food?
I think let's move on. No more.
No more. We're done with those.
We're done with that. Let's talk about Nvidia. The stock looks like it's open pre-market now, and it is up. This, as we see this FT report, certainly causing waves. It seems an indication from the FT reporting that we are going to see Jensen Huang spending significant amounts of money in the United States. He's basically saying, I want to manufacture chips in the United States. He's talking about using fabs provided by TSMC and other companies to provide these chips. But it's basically a big onshore move that we are going to see rippling through. Part of the chips narrative that Biden pushed through, certainly part of the onshoring narrative that Trump is pushing through as well. Nvidia is up by 1.7% this morning. Nike, pay your money, take choice on that one. Also tracking a little bit higher. We'll watch for that one a little bit later. A big move back into sports and kind of elite athletics, and that seems to, or elite athletes, and that seems to, at some point, that will have an effect. Will it show up in these numbers? We're also seeing Rivian being downgraded this morning. Piper Sandler downgrading that target to 13. We are already below that, it looks. Stock is going to be down by 1.94% this morning, judging by the pre-market that we're watching.
Okay, coming up on the programme, we'll talk once again about defence. EU leaders are meeting today to discuss plans to bolster defence spending. We'll take a look at some of the businesses that are well positioned for all of the money that is going to be spent in Europe on defence. We'll do that with Benjamin Heelan from Bank of America Global Research. We'll talk about the companies that are going to be making the things that Europe wants to buy here. This is Bloomberg.
everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Is really needing to ramp up, get its act together, and show that it can deliver.
So you need to protect your airspace, and it's very visible in Ukraine.
The actual thought that Europe needs to start to get their act together.
The budgets that are under consideration is a plan for the next decade to rearm Europe.
We need to step on the accelerator. More money needs to be available, and it needs to be especially, the procurement needs to work faster.
Need more of everything and of a better performance.
Move at least 10 times faster, and the scale needs to be better in shells, missiles, armored vehicles.
Seize of weapons in Ukraine will not erase the Russian threat.
The whole defense kit that the current industry manufactures is just outrageously too expensive. There's still a lot of the old red tape around.
It would be a great risk if we stop those investments just for the sake of the ceasefire in Ukraine.
The US are never willing to rely on anyone else than the US, and the US is right. Why Europe should do different?
CEOs of several European defence firms talking about the arguments that they are having right now about how the region needs to cut red tape, deal with its procurement issues faster. Go, go, go seems to be the narrative. So today we're going to see maybe some evidence of that becoming reality. EU leaders, there's a council meeting taking place today. They are going to be discussing bolstering defence spending plans. We saw early indications of this, obviously, yesterday in terms of the size and scale of the plan and the fact that it's going to be ring-fenced in Europe. The US administration clearly looking in a different direction right now. So we've seen a massive rally over the last few months in European defence stocks as a result of all of this. Ben Heelan is the co-head of developed EMEA Aerospace, Defence and Capital Goods at Bank of America Global Research. Over the last few days, the team has been hosting its Global Industrials Conference in London. It's brought together over 650 investors, 80 companies, and many of them are defence companies. And we've been getting a good idea of how they feel about the world as a result of this conference. Ben Heelan joins us around the table this morning. What was the takeaway?
Look, I think the big takeaway was that companies have been growing for 3 years, right? We're 3 years into this from a Ukraine perspective. But what's happened in the last 2 months has just increased the duration of the investments that we're going to see in Europe. There's obviously this buy European narrative, which is clearly gaining a huge amount of traction. And actually, I think, you know, when we think about a lot of the companies' medium-term growth trajectories that they've given, we're going to see a steeper growth trajectory, but for a much longer period of time. As an example, we had Thales. I saw you had Patrice on the program last week. We had Thales yesterday, and they were saying we could grow for 20, 25 years, given the amount of visibility that we have. So there is clearly a lot going on in terms of negotiations with governments and companies. What can we provide? What capabilities do we need? I think we'll see more colour of that coming in the next couple of months. But it's very clear that Europe is going to be a structural growth market for defence for the next 10, 15 years.
Do I just buy these stocks at current prices, put them in my back pocket and leave them? Or are we in a kind of near-term overbought kind of position? Are there going to be better entry points coming? Or is this as good as it gets? And as you say, the long-term picture looks good.
No, I mean, look, one of the big questions I get is what happens with the Ukraine ceasefire, right? And I think that a Ukraine ceasefire that means that Ukraine would lose that territory and isn't able to get that territory back isn't going to change why Poland, the Baltics, Finland are investing in defence. So I think those fundamental drivers of defence are still there. And if you look at some of the numbers are very stark, right? Germany's procurement budget could go from 8-9 billion euro pre-Ukraine to 60 billion euro in 2030, right? And so when you put the Rheinmetall move in context of that explains why Rheinmetall has moved where they are. So we actually see still decent amount of upside across all of these names. The big debate from here is going to be the ramp. How quickly can you ramp? And what share is Europe and other companies going to get of these increasing defence budgets?
Yeah, Ben, good morning. So in terms of that ramp, how supply constrained are these various businesses? Where is that not an issue and where is that holding them back?
Yeah, so I think, again, we're 3 years into this. So Thales, as an example, has hired 30,000 people in the last 3 years, right, for its defence and aerospace business. They had 1 million applications, right? So finding people, I don't think is going to be the constraint. It's going to be getting those people in the business and training them. That's just going to take some time, right? So there's the easy wins, which is kind of adding an extra shift, right? Adding an extra, shift and a half, etc. So you can see an increase in capacity, I think, relatively quickly over the next couple of years. And companies have been planning for growth, right? So it's not as though the companies haven't been making investments. But I think what you will need is the governments over the next 2 to 3 months are going to have to decide what capabilities do they want, what scale do they want, and we're going to see the contracts come from the governments, provide visibility, provide prepayments, and allow those companies to go out and make investments. Yeah. Rheinmetall talking about taking a VW facility and repurposing it. That's great. It's going to take time to do that, and they need the visibility. And I think that's one of the big changes that we've seen in European defence. It just hasn't had the visibility for 10, 15 years. Okay. It has that now.
Ben, this sounds, in some senses, quite simple. 10 to 15 years, structural growth for this sector. What role do you ascribe to NATO in all of this and all of that complexity around what NATO means now?
Look, I think NATO is still the bedrock of European security, right? But I think what we've realised here in Europe, and I think what the leaders have realised, is that they need the capabilities to do things themselves, right? And there are a number of capabilities that Europe has just come extremely reliant on the US for, whether it be things like rocket artillery, whether it be things like missile defence, F-35 and stealth. Those capabilities don't change overnight, right? We can't change those things overnight. So I think what we're seeing is Europe recognising it needs its own defence industrial base. It needs to take control of its own security. But I think NATO, and we'll see with the NATO summit, and we've heard from Mark Rutte as well about the spending requirements, etc. I think that summit in June, we will see that NATO is still core to European security.
The French want Europe to buy Europe. What does Europe mean? You break out any piece of equipment that an OEM puts together, it's got all kinds of bits in it, and that's a problem. Where does the UK sit in that? What happens with BAE Systems? What happens with Babcock? What happens with these kinds of companies? Do we yet really understand how this is going to work from a political point of view?
Well, I think the Buy European mandate is to correct that capability and defence industrial base gap that we have with the US. So I understand why France wants to spend the money in France and Germany on the European continent. And France is a good example because pretty much all of French defence equipment comes from the defence primes in France, whether it's Thales, Airbus, Safran as an example. What does this mean for BAE? BAE has a sizable European business, right? It has a big Scandinavian business. We hosted Charles on Tuesday, the CEO, and he said he would be open to M&A in Europe. But the UK has talked about going to 3%, and so BAE is a big UK business.
Yeah, we'll certainly watch that story as it develops. Ben, thank you so much. Ben Healing, co-head of Developed EMEA Aerospace Defence Capital Goods at Bank of America Global Research. We'll get back to the central banking narratives shortly. SMB and Riksbank on deck. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, can I say that in Bloomberg?
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I think we're ready.
Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is The Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Welcome back to the programme. We're getting a decision from the SNB, the Swiss National Bank, cutting the policy rate by 25 basis points to 0.25%. The estimate was exactly that, so we had been anticipating this, although UBS had described it as a coin toss. Would you want to use the limited room you have between where you are now and zero to, would you want to use it now, was the question that some were asking, because growth's pretty resilient, there's limited space to cut rates down to zero, and the Swiss franc's been weakening already. So those were the questions being asked as to whether we would get this move, but we have seen a move then in from the SNB. They're also telling us a little bit more about where they see things heading. They see 2025 GDP growth 1 to 1.5%. They remain willing to be active in the foreign exchange market. So interesting that they've decided to go now with this cut when they could have decided not to.
Are they done? Is that it? Is that it? The cycle is over. We've gone as far as we're going to go. We're not going to go below. We are kind of at the limits now.
Yeah.
of what is possible.
And for as much as this was anticipated, we're seeing a spike in the currencies. So it certainly wasn't all built in.
Yeah.
There's some people who had expected that we might get a hold here, and they might keep their powder dry. Valerie's been tracking this. She's been tracking the Riksbank. She's of course all over the Fed story. Let's bring her into the conversation. Valerie, the SMB then. So you need to be ready to be surprised by the SMB, which has happened in the past. I don't know how you define it. No, I mean, the expectation was that we would get this, so no. But the FX market seems to have, not everyone was positioned for it.
Yeah, the S&P is known to surprise. It was only last December they had a 50 basis point cut, which surprised markets. But look, I think maybe the market's moving because there were a few factors at play that would argue in favor of a hold here from the S&P today. One of which being tolerable low inflation, okay economic growth. Fourth quarter GDP for Switzerland came in a 2.5-year high. And most importantly, the franc really hasn't appreciated too much. So there really wasn't, I guess, an urgent need for them to cut. But the S&P only meets 4 times a year. And I think the worry for them is if they did see a resurgence in franc strength on the back of, a risk-off move around trade tensions, that would hurt their export-driven economy, which is also focused on pharmaceuticals. They make up 35% of the exports in Sweden. Trump has talked about pharmaceutical tariffs. So perhaps the cut today in some way guiding against any further franc strength to come.
I see your SNB, I raise your Riksbank. It is also, it seems, maybe on hold from here, and is actually guiding maybe a little bit more explicitly that is the case. Assesses the rate path will remain at this level going forward. Nothing to see here. We're going on holiday.
So there was some speculation that we could see more clear guidance that maybe the next move is a hike. There was an unexpected surge in inflation in Sweden recently. Fourth quarter growth came in strong as well. So we didn't necessarily get strong language that the next move is a hike. Instead, they've just said that we remain on hold going forward. We do get some more guidance from them in terms of their rates, their GDP and their inflation forecasts as well.
So what they're saying is, so this is interesting. Outlook for inflation and economic, the outlook for inflation and the economic story largely quote intact, but uncertainty abroad is unusually high.
Yes, we heard that from Jerome Powell, but he wasn't talking about abroad. He was just talking about uncertainty. This seems to be a theme that many central bankers will return to.
Yeah, well, I guess the question for the Fed is, if uncertainty is so high, does that mean you cut, or does that mean that you stay stable and stay where you are? And I think the Jerome Powell's answer yesterday was uncertainty is so high, so we're not moving. We need to wait for more clarity, which I know you guys have talked about. Is that hawkish or dovish at the end of the day if they intend on holding rates steady?
Absolutely. It depends on where you start from in terms of your positioning, whether or not you view this as all as hawkish or dovish, I guess. But I think the real takeaway from me yesterday, he's basically saying the dots, we don't know, so the instinct is not to move the dots. There's always this kind of assumption that there should be some activity.
Yeah.
We were joking earlier that the dots should be actually emoji. Should they be kind of happy faces or sad faces, depending on which kind of way you see?
Yeah, so even if it doesn't move, there's some emotion expressed by the dot.
Around the dots. The dot needs to have added emotion.
Genius idea, Guy. You should propose that to
we thought it was a little too Gen X, though. It might not go down too well with a forward-looking Fed. But any other takeaways in terms of the broader picture then, Valerie, as to what we heard from the Fed? Because clearly, yes, there's a huge amount of uncertainty about what tariff policy is going to do to inflation. And Jerome Powell was very cognizant of that and acknowledged that very openly. They really don't know how much of any uptick in inflation is being driven by tariff threats.
Yeah, he said that a few times. So, yes, we upgraded our inflation forecast, but I can't give you a breakdown of what's tariff-led inflation versus not. And he actually had a funny quiff about that. He said in the last round of inflation, there were tariffs on washing machines, but we also saw prices of dryers increase. So there's a lot of funny things that happen around inflation and tariffs. They're not sure how it's going to work its way through an economy, so they're going to stay stable. But
it's an interesting one.
We did see it in there.
Something about a spin cycle. There's got to be something about it.
No, I was just going to pricing power. I think, if you make washing machines, you also make dryers. Maybe a tariff on washing machines gives you more pricing power around your dryer.
Yeah.
I mean.
Yeah, so, the possible effects of inflation due to tariffs, is it going to be persistent or transitory? If you look through how they upgraded their inflation forecast, it gave a big bump to this year, but they see it coming down in the years afterwards, which is another hint that they think it's transitory.
So there's a constant spread between washing machine prices and dryer
This is going to stick in guys' mind now. This is now his daily obsession.
But it's a very interesting fact, I thought.
Yeah, no, it is. I am stunned that he is ready to use transitory.
Yeah,
I have excluded that word from my lexicon in terms of I think we should ban that word. But Powell clearly feels that it's still a word that he can use.
Or it just shows us that he's more concerned about the downside risks to growth from these tariffs rather than a resurgence in inflation. So
I would have thought he would have come up with another word. Is really my point.
Yes, that one's got some bad connotations.
But I suppose maybe he just wanted to use it like any other word, so it didn't take on this meaning.
Yeah,
yes,
quite possibly.
But I still want to use it. It doesn't have bad connotations for me. We've just had a couple of central banks basically talking about the uncertainty that exists elsewhere in the world. Valerie, thank you very much indeed. Let's talk about what we're seeing in terms of the UK, because this is going to be represented, I suspect, with the Bank of England as well. UK wage growth holding at its highest level in 9 months. The data, we saw that this morning. Unemployment ticking a little bit, employment ticking a little bit higher. The Bank of England out with a decision a little bit later on. We're not going to get a press conference. We get a statement, we get a little bit of detail, but not very much. So let's look ahead to what we can expect from the Bank of England. Lizzie Burden joining us on that. Lizzie, talk us up for this midday policy announcement. How much detail are we going to get given the uncertainty that exists?
Well, you talked about the wage data that came out this morning, Guy. That's not going to give much confidence to the people in there when it comes to this decision and the policy making ahead. The bottom line of it all is that the labour market is still tight, and caution really has been the watchword ever since the last vote. Even, you had Dave Ramsden, Deputy Governor, very much seen as a bellwether on the committee, him calling for caution. Even Catherine Mann, who, of course, surprised markets by going from arch hawk to arch dove, voting for that jumbo cut. Even she is now emphasising the need for policy to remain restrictive. So I think they will keep the guidance that it needs to be gradual and careful going ahead. Careful, the word they added at the last meeting, because of all of that uncertainty you were just talking about in terms of Donald Trump's trade policy. But there's also worries here about the impact on inflation expectations and the second round effects in terms of wages and prices. But as you say, no press conference today, no updated forecasts. They might hint that the growth and inflation outlooks at the moment are too low, but markets currently pricing in 2 more cuts for the rest of the year. At the moment, it looks like the Bank of England is going to be more hawkish than the Fed, and that's why this week you've seen the pound popping above that $1.30 level.
Yes, so take us to next week then, Lizzie, because we get from the Chancellor a spring statement, and I think this months ago there was a hope that this would be a bit of a non-event because we'd already seen some big tax rises in the budget, and business had been very outspoken on that, and so hoping that this would pass kind of smoothly and unnoticed. But as bond markets have done what bond markets do, the pressure has built.
Yeah, and of course, Rachel Reeves made the promise that she was only going to have one fiscal event a year. It looks like this could be more significant than she'd planned back in October. Interestingly, I was speaking to her on Monday, as you know, and she hinted strongly that she understands the need to build up a fiscal cushion again. She only left herself £9.9 billion of headroom against her fiscal rules in October. As you say, Anna, that's now been eroded. And we have had it confirmed now, our colleagues on the government and economics team, Bill Aldrich and Joe Mays, that indeed that headroom is going to at least stay the same but maybe go up. She's ruled out more tax rises. She's ruled out breaking her fiscal rules. So it looks like it's going to come from spending cuts. We already know that there are going to be cuts to the welfare budget, to the aid budget to fund defence, that they're cutting the pensioners' winter fuel allowance. So to many, this looks like the sort of thing that a Conservative Chancellor would do. And I think what's most fascinating is it seems Rachel Reeves is more worried about the bond vigilantes than she is about the left wing of her party.
Lizzie, thank you very much. Lizzie Burden outside the Bank of England. We'll bring you all of the details and everything that goes with the Bank of England rate decision later, not the press conference. Isn't one this time around. We're hearing from the banking sector in Germany.
So there's this Morgan Stanley event that's taking place currently. We've seen a series of CEOs over the last few days speaking at it. Bettina Orlopp speaking right now. I just want to give you a little bit of context, though. So UniCredit's Uchel has been speaking as well over the last day or so. He says that basically he can sit and wait for Commerzbank until 2027. So he's giving this deal a long time to come to maturity, his acquisition of that, were it to go through. Bettina Orlopp is out this morning talking about the fact that she basically treats Uchel like any other shareholder, regular contact, but nothing kind of extraordinary. The line that really stands out for me in what she is saying is that basically we need banking union before we can get cross-border M&A. So basically she's pitching it back towards the politicians and saying, and this is on the agenda today at the council meeting, get banking union done and then we can get cross-border M&A done.
Yeah, Christine Lagarde's been talking about the need for a single market. We've talked with a couple of guests this week about the need for capital markets union, or is it savings and investment union, whatever you want to, acronym you want to attach to it. So we'll continue to monitor that one. Commerzbank shares then down by 3.5%. Coming up, we will return to the EU Leaders Summit that's taking place. The subject is defence. We're seeing leaders arriving for that meeting in Brussels right now. The Dutch leader, the Dutch Prime Minister, is speaking currently. Dick Schoof talking to the media as we speak. We'll monitor that conversation and all the others as these leaders arrive. Trump's shift in policy, of course, top of the agenda. That's next. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis. And we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulators said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Welcome back to the opening train at 8:45 here in London. European equity markets not moving all that far, up by 0.2% though now. So after early expectations set by futures maps that we'd track a little bit lower, maybe we're turning tail and following the US futures picture a little bit higher. So US futures guide pointing up by 0.5% on E-minis. And of course, we'll watch tech names on NVIDIA news.
Do you want to talk about catering?
Yes, and catering stocks have been doing quite badly in Europe. There we are.
There we go. Let's turn our attention to this morning's big take on the Bloomberg. Cheap Chinese goods are flooding emerging markets as President Trump's tariffs force manufacturers to look elsewhere to move their exports. Indonesia has lost roughly 250,000 jobs in the clothing industry over the last 2 years, while Mexico has seen large-scale job losses in its shoe and textile sector. Let's bring in Bloomberg's Bill Farris for more on the story. Bill, I'm curious. Trump hasn't been in for 2 years. He's only been in since the beginning of the year, and we've seen this effect over the last 2 years. So I'm wondering kind of what's really happening here? What is going on? Is this a bigger story that the tariff story is only accelerating, but a trend that was already in place?
Yeah, that's right. It's a great question. Some of this can be traced back to the first Trump presidency when he started instituting some of those surprise tariffs on China back in 2018. But then in 2020, as China started having problems with its property sector, you saw the country investing a lot more in expanding its manufacturing base. And that was both to increase a little bit of the domestic consumption, but to produce a lot more exports. But with the U.S. market slowly getting a little bit tougher in terms of tariffs and the disputes between the countries, China's exporters really began looking across the emerging markets for other opportunities out there. That was something you heard a lot about from Janet Yellen during the Biden administration. You heard some concerns about that from European leaders over the last several years. But now, facing a potentially new wall of tariffs coming in from the U.S., it's a trend that is really accelerating. So one of the things I think in that big take story today that's interesting is you see there were 250,000 job losses in the textile industry in Indonesia over the last couple of years. The industry there now warning that you could have 500,000 additional job losses this year alone as those tariff barriers climb.
Okay, yes, and you get a sense then it gets worse in emerging markets, but perhaps also elsewhere, Bill, because the story focuses on the impact this has had on emerging markets. But as you say, European leaders have voiced concern about the same thing happening in Europe. So where do we get this sense that this worsens from here?
Well, you have obviously with if the tariff barriers are continuing to climb in some of the biggest markets like the U.S., that forces China to start looking elsewhere to send its goods. What we've seen is that China's total exports, its share of global exports, has basically held steady over the last several years, but there's been a real shift in where those exports are going. So sales to the U.S. Are not quite as high as they used to be, but they've made up for that by going to places like Brazil, like Vietnam, like Indonesia. Sometimes that is part of this rerouting of supply chains so that if you can't directly export from China to the U.S., you can set up a factory in Vietnam and perhaps export from there. But some of it is also using those local markets, many of them in Southeast Asia, as your primary destination. And that's putting a lot of pressure on the local manufacturers across the region, across emerging markets, who really struggle to compete with that efficiency in the massive Chinese market that's built up over the last several years.
Bill, is China too big to fight? Can these countries push back in any shape or form?
It's a very tricky situation. So you have seen countries like Mexico talk about imposing some pretty steep fresh tariffs on Chinese imports. You've seen Canada talk about that. And it's something that's come up in other countries in terms of putting restrictions on, for instance, direct mail sales from China into countries like Vietnam. But the trickier part of it is that China is also, for most of these countries, one of their biggest foreign investors and their biggest trade partner. So, you know, if China is there investing in a major port or major infrastructure projects, these countries have to decide if they want to pick a fight over some of these lower value goods. I think the big question is at what time, where does the pain point come in? So in Indonesia, like we said earlier, you talked about 250,000 people perhaps having lost their jobs in textiles over the last couple of years. As that climbs, is there going to be more pressure on governments like Indonesia, elsewhere in emerging markets, to do something a little more serious to tackle this threat?
Bill, thank you very much. Bloomberg's Bill Ferry's joining us there from Singapore. Let's move on from tariff threats and how tariffs are reshaping the global economy to some of the other geopolitical policies coming out of the White House right now. In a call with President Trump, Ukrainian leader Volodymyr Zelensky has agreed to pause strikes on energy assets, echoing an agreement the US and Russia made just earlier this week. US Special Envoy Steve Witkoff says he's hopeful a full ceasefire between Russia and Ukraine can be reached soon.
On Monday, we actually have the technical teams going, and why? Because that's what we're down to. We don't need to have the larger overarching discussions. That's been had, and it was completed yesterday between the two leaders. They agreed on a pathway to some ceasefire conditions today and to a full-on ceasefire that will be negotiated over the coming days. I actually think in a couple of weeks we're going to get to it.
For more, let's go to Bloomberg's Oliver Crook, who's at the European Council building and joins us now. Ollie, you're there in Brussels, the European Council gathering, European leaders gathering to talk about their stance on Russia, on Ukraine. But I think the stage for further talks on Ukraine, those conversations actually, with the United States at least, happening in Saudi Arabia. So how do we look at Europe's role in these conversations now?
So I think Europe's role in these conversations is very much sort of catching up and basically getting briefed after these conversations occurred between Donald Trump, Vladimir Putin, and Zelensky as well. And basically what this European Council meeting is about is to get Europe into a position where in the future it will actually be a relevant player in these kinds of discussion. We have learned from the Trump era that basically power is no longer really garnered through these sort of diplomatic means, these old sort of alliances and these old sort of friendships. That doesn't guarantee you a seat at the table. It's really guns, ammo, and dollars, right? And that is basically what these European leaders are here to do. They are here to implement the plan that we got the outline from a couple of weeks ago from Ursula von der Leyen, the so-called Rearm Europe Plan 2030, which is basically trying to get the European continent in a shape to potentially fight a war in the next 5 years. So that includes a number of different things. That includes a large degree of loans from the EU. 150 billion euros have been put forward, changing the mandate of the European Investment Bank in order to enable investment in the defense industry, which is currently prohibited or is limited to dual use, redirecting some of the funds from the EU, obviously changing those fiscal rules, which are absolutely key to get sort of headroom at the national level, which is in part what allowed Germany to do what it did a little bit earlier this week, which we expect to pass here on Friday. But all of this to say, basically, and I think this is a sort of another interesting point that we heard from the sort of French, we can kind of count on the French to say the quiet part out loud in many of these discussions, basically saying that you would not only need to buy more military equipment, you need to buy more European, because if the United States is not a reliable partner, if they are sort of willing to use every bargaining chip to get an advantage, then if you get all of your military equipment from them, military equipment, which, by the way, often needs American personnel to operate and needs software updates and these sorts of things, it puts you in a very vulnerable position. So a lot of the focus will also be in sourcing that out of Europe, of course, and we've talked about many times, that will take, a decade or so to build out that capacity, but that is the conversation before European leaders today.
Let's talk about the transactional nature of what is happening in Ukraine at the moment. There's obviously the conversation around the fact that the White House wants access to Ukrainian rare earths. There's now a conversation apparently around power stations, though there does seem to be some uncertainty. The White House suggesting maybe that there's this power station conversation going on. Zelensky seems to be saying something slightly different. I'm reading a piece in the Frankfurter Allgemeine saying he only talked about Zaporizhzhia. Ollie, the UK Defence Secretary has talked about this being kind of already being a position where we are talking about this being kind of expropriation. We're talking about really kind of strong words being used. Just give us the lowdown as to what is happening here.
So listen, it depends for what your perspective is. From many of the European perspective, and again, it's very difficult for anyone in any official capacity to say this stuff out loud. This is basically an extractive economic policy by the United States. On the other hand, the Trump administration and the U.S. would basically make the point that basically they need to explain to their taxpayers why they're sending hundreds of billions of dollars to a country that many of the people in the United States do not see a direct connection to their personal lives, and basically trying to recoup some of that investment. Again, and Donald Trump is throwing a lot of different things sort of, it seems at the wall. There was There's, of course, the minerals deal. That seems much more concrete. And now this question about sort of energy assets. We got a little bit of a briefing of what that could look like from the White House press secretary. Have a listen to what she had to say.
President Trump also discussed Ukraine's electrical supply and nuclear power plants. He said that the United States could be very helpful in running those plants with its electricity and utility expertise. American ownership of those plants would be the best protection for that infrastructure and support for Ukrainian energy infrastructure.
Of course, running the power plants and owning the power plants maybe not are not exactly the same thing. The point that they're trying to make, however, is that American economic investment in Ukraine is the best kind of security guarantee. Of course, the point that the Ukrainians would make and have made on a number of occasions is that there were a number of businesses that already had financial interests in Ukraine, and that did not prevent the invasion, nor did it prevent the invasion of Ukraine. And this is the point that the Europeans are making as well.
Ollie, great stuff. Thanks for the update. We'll continue to update everybody as we work our way through the morning. Leaders are currently arriving in Brussels. So that's certainly one of the big elements on the agenda today.
Yeah, absolutely. Looking for what they have to say about sanctions, their attitude to Russia. Is there an increasing dividing line across the Atlantic there? Because according to the draft that we've seen, it looks as if Europe still wants to go tough on sanctions on Russia and stands ready to increase those. We've also got a Bank of England rate decision. Lizzie Burden outside there in the cold, looking for headlines there. Perhaps a little hawkishness creeping in from the BOE.
A lot of uncertainty seems to be coming out of European central banks this morning. We'll see whether we get a similar story coming out of the Bank of England. We'll bring you live coverage of that as we get to that at noon. That's it for us. The brief is next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Good morning from our global headquarters in New York. I'm Vonnie Quinn. Danny Berger is on assignment. Welcome to Bloomberg Brief. Let's set your agenda. Riding high, equities extending their rally after Fed Chair Jerome Powell downplayed growth concerns. President Donald Trump urging a rate cut. Next up, the BOE also expected to keep rates on hold. The United Kingdom posting strong wage growth ahead of that decision. And shares of Nvidia marching higher as Jensen Huang lays out plans to spend hundreds of billions of dollars on US-made chips and electronics. So let's take a look at those markets, because we did get a rip-roaring rally yesterday after the Fed decision. Now, let's not get carried away. We're talking about a 1.1% gain on the S&P 500, but it looks like we might be extending that gain into today's session. The Nasdaq 100 posted a gain of 1.3%. Now, we're still in correction territory, but if those gains continue today, we might just get out of it. The Nasdaq 100 futures there pointing to gains of more than 0.5% at the open. And even the Russell 2000 showing gains at the open today. Let's move on to bonds, because bonds were also higher. In fact, we saw a massive decrease in yields as traders started to price in perhaps more cuts by the end of the year, in contrast to what the median data is now saying. But look at that two-year yield. It's below 4%, 3.97 just a moment ago. That 10-year yield now down to 4.2274. And we're also keeping an eye on copper and gold, as well as sterling, of course, which is weakening ahead of the BOE decision and after the jobs data. Copper trading just off that 10,000 mark, which it did reach, and gold just off its record high, which it also reached as well. We're also keeping that eye on Nvidia. CEO Jensen Huang said in an interview with the Financial Times that the chipmaker will be spending hundreds of billions of dollars in the US over the next 4 years. Shares of Five Below surging too after the discount retailer reported fourth quarter results that beat expectations, along with a solid sales outlook. And Carvana is rising after an upgrade from Piper Sandler to overweight from neutral, with a price target of $225. And in just moments, we're going to be speaking to Wei Li of BlackRock. Later in the hour, Torsten Slok of Apollo Management joins. So the S&P 500 posting the best Fed day then since last summer after Chair Powell downplayed growth concerns, even as the Fed came out with a revised economic projection for weaker growth, higher inflation. BlackRock weighing in on the rate path, writing, quote, "We think the Fed will find it difficult to cut more than once or twice this year, even if prolonged uncertainty starts to hurt otherwise healthy growth." Joining us now is Wei Li, Global Chief Investment Strategist at BlackRock. So Wei Li, we did see a calm Fed chair yesterday, and obviously the equity market responded to that, but it was also a Fed chair that forecast weaker growth, higher unemployment, higher inflation, and that's not typically a good scenario for any economy. How do we get out of this conundrum?
I think heading into the FOMC, markets were rattled by recessionary fears. So the fact that, I guess, Fed chair didn't play to recessionary fear helped sentiment. But I am a bit bothered by the fact that his characterization of the impact of tariffs on inflation as one-off. And he also characterized the labor market as balanced, but I still see tightness in labor markets that could keep wage pressure elevated. So bringing the two together, the way that he characterized the tariffs' impact on inflation and the way that he characterized labor market, I see that actually potentially leaving the Fed exposed to upside surprises to inflation. So far, as you say, Bonnie, that markets liked it, but I am a little bothered by the inflationary assessment. But the fact that we have come a long way in terms of positioning in U.S. equity market. You look at sentiment in U.S. equity market right now, bear sentiment is a recent year high. And the fact that recessionary pricing in our assessment is a bit overdone. So we like U.S. equity market, but I am a bit bothered by the inflation characterization.
Well, it does seem like traders, at least swaps traders, also feel like perhaps inflation might become, more of a difficult challenge later in the year. They're now pricing in 3 rate cuts, and Fed funds futures are looking at 2 plus a more than 50% possibility of a third. How many rate cuts do you see for the year? What would be, something that the Federal Reserve and the economy could live with?
We think that it's going to be quite hard for the Fed to cut more than twice. So market pricing of close to 3 cuts for this year is perhaps a bit overdone because markets are still expecting the Fed to be able to come to the rescue of the economy if economy slows down. But the trade-off facing the Fed, i.e. the growth inflation trade-off, is becoming quite difficult. It's becoming very, very tough indeed. So faced with inflationary pressure, we don't think that the Fed can cut like they were able to in the past. And as a result of that, we think that actually the Treasury move to price in more rate cuts and yields falling is a bit overdone, which is why we are underweight U.S. Treasury. We overweight U.S. equities.
Why then overweight U.S. equities if there are so many challenges out there? And you didn't mention the word transitory, but you spoke about how the Fed chair characterized the potential inflationary impacts of all of the tariff policies that we might be seeing within the next few weeks. He also said that trade, fiscal policy, immigration and regulation will all need to be taken together and the net effect of all of those judged. So clearly there is a lot of uncertainty out there. Why should equities keep rallying?
That's actually a great question. Let me clarify a little bit. We have an overweight in U.S. equities over the 6 to 12-month horizon, but in the very immediate term, and specifically I'm looking at April the 2nd, heading into a tariffs announcement, I think it's possible that markets could come under further pressure because of this significant policy uncertainty and the corresponding higher risk premium that investors ought to demand because of the higher policy uncertainty. But the big picture is that the U.S. economy is actually doing fine. You know, market pricing for increasing recession probability in our assessment, you know, like at some point it was 10% peak to trough. Correction is overdone. We're talking about an environment where hard data is still holding up. Earnings expectation in our assessment should still also hold up, and any policy uncertainty can feed through to dragging economy down only if they prolong over a extended period of time. But we do think that pain in markets could force policy clarity. So over the 6 to 12 month horizon, we do believe that the case can still be made to be overweight U.S. equities, especially given the correction in multiples, and also the correction in very, very crowded positioning is behind us, actually.
Right, Whaley. So if we are looking not unattractive, are there spots in this market that look particularly cheap now or particularly attractive to jump in on? And what do you do with tech?
I would say that when we characterize our view on U.S. equities as overweight, we're staying tight with our overweight view rather than jumping in at this moment, because, as I said, as we head into further policy uncertainty, key dates, key events, markets could be whipsawed and come under further pressure. But specifically to your question about tech has gone through significant actually derating. You look at NVIDIA, less than 25 times forward earnings. It is trading at a lower multiple than when ChatGPT was first rolled out. You look at Magnificent Seven, they're trading at similar multiple as when ChatGPT was first rolled out. And when we look at the fundamentals of the tech sector and of these companies, profitability, margin forecast for this year and next year, earnings, they haven't deteriorated significantly. You look at CapEx, which is a big thing that we are paying attention to understand how much pent-up pressure there is to further build out the AI infrastructure. They actually, the commitment, they have increased 40 times, the hyperscalers, 40% versus what was already a record year last year. So the fundamental picture in our assessment hasn't really deteriorated to warrant the significant repricing that we have seen in the sector, which is why we are also overweight tech at the moment. But obviously, near-term uncertainty is something that investors ought to feel comfortable with to stick with the overweight.
Whaley, thank you so much. Whaley there of BlackRock joining us. And coming up, rearming Europe, that's on the agenda as EU leaders' defence summit takes place. We'll go to Brussels next. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Ukrainian President Volodymyr Zelensky has agreed to a proposal for a mutual halt to strikes on energy assets. That as an initial step in President Trump's effort to end the war in the region. For the latest, Bloomberg's Oliver Crook joins us now from Brussels. So, Ollie, Ukraine has agreed to the partial ceasefire, at least on those energy assets. What's the read on this out of Europe?
Yeah, so listen, I think everybody is taking, at least very publicly, a very positive approach towards what Trump is doing and the sort of way that he's going about this, because I think he's made it very clear that there's his way or the highway in terms of how these negotiations go. We saw that after the blow up with the Oval Office with Zelensky a couple of weeks ago, then the withdrawal of the military aid and intelligence from the United States. And the Europeans have been often very sort of impotent throughout this process in terms of being able to actually get Trump to steer him in either direction. So basically, everybody has been trying to sort of get on board with the Trump plan here. We understand also when we heard from Steve Witkoff yesterday, who's been the sort of chief negotiator so far in terms of the ceasefire proposal with Putin and really sort of laid the groundwork before that call between Trump and Putin, that he also did brief some of the European leaders. We understand he spoke to Emmanuel Macron yesterday, who responded very positively. So I think overall there is a sort of sense that the Europeans are getting on board with what Trump is sort of planning. There is, however, a sort of moment of reserve here. There is a lot of mistrust that Putin is really sort of sincere about his efforts on a sort of ceasefire deal, and there is also not a sort of clear understanding that Trump and Putin are really as on the same page as the administration would like to present. That being said, there is forward progress being made, and that is being sort of welcomed here in Brussels.
And then, of course, the EU leaders are arriving just now in Brussels, really ahead of their meeting to discuss defence spending. What are we expecting to learn out of that meeting?
So what we're expecting to get is basically the concrete proposals of the sort of outline that was laid out by Ursula von der Leyen a couple of weeks ago, which basically is this Rearm Europe Plan 2030. And this is basically getting the European economy and the various member states onto basically fighting footing potentially in the next 5 years. There's been massive underinvestment on the European side into the defense sector. So there are a number of initiatives that have been proposed by the European Commission, which will now be reviewed by the member states, the leaders of the member states. That includes a large sort of set of loans, 150 billion euros from the EU to nations to member states in order to build out military, maybe changing the mandate of the European Investment Bank so that they can invest more directly into defense, rerouting different funds. So this is something that was outlined a couple of weeks ago. This is the point at which it becomes sort of concrete policy, concrete language, and then moves forward into the sort of initiative of actually getting into policy. What is interesting, and I'll just end with this, is that we heard something from the French, which I thought was very, very interesting, which is basically indicating that more and more of this money needs to be spent within Europe on European hardware, because if the U.S. administration is proving itself to be an unreliable ally, if you are fully dependent on that American hardware, they could use that against the Europeans in the future. And of course, a lot of these instruments, a lot of these sort of military hardware need software updates and need the United States in order to run. And that is something that is also weighing on leaders, though very few will acknowledge it openly.
Protectionist comments there as well. Oliver, thank you so much. That is Oliver Crook for us in Brussels. Well, over in Washington, President Donald Trump said the Fed should cut rates to help his incoming regime of reciprocal and sectoral tariffs, quote, ease their way into the economy. The post on Truth Social splits with previous comments from his administration that their focus was not on rates, but on the U.S. 10-year Treasury yield. Bloomberg's Kevin Whitelaw joins us now from Brussels. Kevin, are we seeing Trump return to pressuring the Fed chair? Will it have any impact?
I mean, this is something that I think everyone knew was going to happen and keep happening, you know, despite various protestations. Trump has always had opinions about the interest rate and where it should be. He's usually disagreed with whoever the Fed chair is, whether or not he's been president. So during Trump's first term, we heard these kinds of calls a lot, and of course, we're hearing it again now. You know, Trump's basic philosophy seems to be that, hey, I'm going to do these policy things and the Fed should be helping me out. That's obviously not the way the Fed normally looks at it. They sort of process, you know, the economic data and then make their decisions based on that. And so I think that's probably going to continue. But obviously in the background is that question about, you know, what Trump might or might not do down the line when it comes to Jerome Powell's job.
For sure. Well, tariffs, as we know, are definitely still coming April 2nd. And now India is going to be included, according to the president. What do we know about what kind of tariffs will impose on Indian goods?
Well, at this point, we're really expecting this to be a global thing. And essentially what they're saying is there really are no exclusions. But we do expect potentially different rates for different countries. And so I think everybody is trying to understand what they really mean, how serious they are. Is this the beginning of a negotiation, or is this simply the beginning of a structural change that Donald Trump is trying to make with the world economy, one that could be incredibly disruptive and incredibly painful, both to U.S. trading partners, but also potentially to the U.S. economy. And so one of the things from the European side they'll be looking at is whether or not they try to apply different tariff rates to different countries within the EU, which has yet another potential to sort of make it even more challenging for the European Union to figure out how to react to what, you know, potentially an uneven set of tariffs.
All right, Kevin, we have to leave it there. Thank you so much for all that perspective. That is Kevin Whitelaw for us in Brussels. Coming up, we'll push ahead to the Bank of England decision in just a few hours. That's next. This is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Time now for our front page news, a look at what's making headlines around the world. First up, the Financial Times reporting NVIDIA will spend hundreds of billions of dollars on chips and other electronics manufactured in the US over the next 4 years. The company is tilting its supply chain back from Asia in the face of the president's tariff threats. In a wide-ranging interview with the FT, Jensen Huang said he also sees a growing competitive threat from Huawei in China. Next up, the Wall Street Journal reporting the Trump administration is considering a plan to extend Chevron's license to pump oil in Venezuela. The president's team is weighing a plan to impose tariffs or other financial penalties on countries that buy oil from Venezuela. Chevron has long warned that China could tap into Venezuela's oil resources if the company's license is revoked. And on the Bloomberg, UK wage growth held at its highest level in 9 months and employment rose. This all evidence of a tight labour market and will likely keep the Bank of England cautious over further rate cuts when it meets today. Our UK correspondent Lizzie Burden joins us now from outside the Bank of England in London. So Lizzie, break down the jobs data and what position it leaves the BOE in.
Well, Vonnie, this data came in bang in line with expectations, but you put it right. The bottom line is it really underscores that tightness in the labour market continuing, which is not going to do anything to assuage the BOE's concerns about the persistence of inflation here in the UK and the second round effects, because caution really has been the watchword out of all of the Bank of England commentary that we've had since the last decision. You've heard it from the likes of Dave Ramsden, the Deputy Governor, who's kind of seen as a bellwether on the Monetary Policy Committee. You've seen it from even Catherine Mann, who, you'll remember, surprised the markets last time by going from arch hawk to arch dove by voting for that jumbo cut. And then now she's been emphasising the need for policy to remain restrictive. So we're expecting a hold today. We're expecting them to keep this guidance that the path ahead will be careful and gradual. But we don't get a presser, we don't get forecast. The expectation in markets, though, you'll get 2 more cuts after this.
Well, and of course, sequencing matters, and this BOE decision comes before the Chancellor's spring statement next week. How will it impact that statement?
Well, of course, Rachel Reeves would love it if the Bank of England would make her life easier, Vonnie, and just make government borrowing cheaper. But it looks like her headroom that she left herself at the October budget has been eroded. And interestingly, I was speaking to the Chancellor on Monday, and she heavily hinted that it's important to her to rebuild that fiscal cushion at the spring statement next week. It was only £9.9 billion. And indeed, our reporters, Phil Aldrich and Joe Mays, have had it confirmed that she's going to rebuild at least £9.9 billion of headroom. Now, she's ruled out more tax rises. She's ruled out bending her fiscal rules, so that leaves spending cuts. And given that we already know some of that's going to come from welfare cuts, this is something that she's getting absolutely slated for from the left wing of her party. And, Vonnie, the thing that really is fascinating to me is it seems she cares less about that left wing than she does about the bond vigilantes swirling the UK government.
For sure, and of course we're also seeing sterling weaken, and that's obviously a today move, but we have seen the governor begin to speak a little bit about tariffs, Lizzie, which is interesting because they had been avoiding talking about the potential impact of any US tariffs until fairly recently. Should we anticipate hearing anything about potential tariff impacts today, given that we already did from the ECB?
Well, no press conference today, Vonnie, but in the last meeting's guidance, they did add that word careful in response to the uncertainty around Donald Trump's tariff threats. Now, the UK looks for now like it's going to avoid Donald Trump's tariffs, but there is, as you suggest, the ripple effects from tariffs on the EU and China that would keep the UK in the crosshairs here. And this is partly what is fueling the concerns about the second round effects. If you have businesses and consumers, inflation expectations raised as a result of those tariff threats, and then you have wages higher and prices higher, that could cause a problem for Threadneedle Street.
For sure. Lizzie, thank you so much. And Lizzie will be outside the Bank of England all morning long. Don't forget, that decision comes at 8 a.m. Eastern this time round. There's only 4 hours between us and London during daylight savings time. Coming up, the Fed flagging stagflation risks, lower growth and higher inflation. Apollo's Torsten Slok next. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit. Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
From our global headquarters in New York, welcome to Bloomberg Brief. I'm Bonnie Quinn. Let's set your agenda. Riding high, equities extending their rally after Fed Chair Powell downplayed growth concerns. President Donald Trump urging a rate cut. Next up, the Bank of England also expected to keep rates on hold, the UK posting strong wage growth ahead of that decision. And shares of Nvidia marching higher as Jensen Huang lays out plans to spend hundreds of billions of dollars on US-made chips and electronics. Let's have a look at those markets, though, because we are just fading a little bit, but we are still higher. That would be after the best day since last July for equities after a Fed meeting. We see S&P futures up about 0.2% now. The S&P 500 did rise about 1.1% in yesterday's session after the Fed chair's comments. The Nasdaq 100 still in correction territory, still down about 11% for the year, but those futures look to be rising as well after a 1.1% gain yesterday. and even Russell 2000 futures are higher, although, as I said, with just about 4 hours to go, we are fading those gains. Let's look at the bond market, because we had some very interesting moves. 10 basis points drops in many cases. The 10-year yield down to 4.22. The 2-year yield is now below 3.97. So that bond market is definitely pricing in more rate cuts to come. The 30-year yield at 4.52 right now. And then let's just take a quick look at copper and some other precious metals. Gold just off its record high, which it hit after the Fed decision, 357 it was at. It's now at 3,045. Copper just coming off the $10,000 mark. There's apparently between 100 and 150,000 tons of copper redirected from Asia on its way into the United States, just in case those tariffs do go on copper later in the month and in the year. And sterling weakening even further now, 129.49 before the BOE decision. So the Fed then out with a fresh summary of economic projections for the year. GDP revised down, PCE inflation revised up. Apollo's Torsten Stock writes this: the FOMC message is that we are in a stagflation economy with lower growth and higher inflation. I'm pleased to say Torsten joins us now. He's chief economist at Apollo. Torsten, that is the dreaded scenario, and you say we're already in it. Did the Fed just prove that yesterday?
Well, I think the challenge for them is the following, that there are two things in the economic outlook that are very, very important. First of all, sentiment has already deteriorated for consumers. We've seen consumer confidence go down significantly. We've seen the expectations to business conditions go down significantly. And we've seen the expectations to inflation also go up significantly. That's, in other words, consumers are saying we are getting some stagflation, and that will likely continue. Corporates are also saying that confidence is now weaker. They are saying that CapEx plans to expand their businesses, has also been going down. So this sentiment deterioration has been very significant. But what markets are not pricing in particular equity markets yet, is that these effects will likely have some negative consequences for earnings. Tariffs and trade wars do have negative impacts on earnings, and that's what still remains to be seen, namely, how negative will that impact be? So that's why the optimism in equity markets here at the moment is unwarranted, when you both have sentiment that is quite negative, and at the same time, the coming negative effects of tariffs on earnings in the U.S.
Sure. The Fed chair, though, downplaying those survey-based inflation expectations and also some of the consumer data, he didn't seem to be too concerned about what they were showing. He thinks inflation expectations are still well anchored, particularly market-based ones.
You're right, Vonnie, and that was actually very unusual. If you look at inflation expectations, in particular University of Michigan, both 1 year and 5 to 10 year was really going up in the last print. And in that sense, it was somewhat surprising that he's downplaying that and saying, oh, we're not too worried about that. There are some issues around who are the respondents in the University of Michigan survey in inflation expectations. And it is correct to say that market-based inflation expectations have been well behaved, at least more well behaved. But the bottom line to your question is that it is a little bit surprising that he just decides to say, oh, the sentiment data may be bad, and we're only looking at the hard data, because it's always the case that sentiment leads the hard data that potentially could be slowing down. And the next important data point will be non-farm payrolls on April the 4th. The survey week for that was last week, because the survey is always done in the week with the 12th. And of course, if you look back to last week, the fears and some of the heightened uncertainty is bringing the conclusion that there is a risk that non-farm payrolls could be weak in March when it comes out on April the 4th.
Well, certainly the Fed is looking for the unemployment rate to go up at some point this year, right? Just by a tick, but nevertheless. So if that is the case, that we have gone from navigating a soft landing to actually trying to navigate stagflation, if that's even possible, is there a way for the Fed to finagle rates or monetary policy to get us out of that stagflationary environment quickly?
Well, that's a very, very important point, because the difficult thing for the Fed is that when growth slows down, which is the stack part of stagflation, then the Fed should be cutting. Well, the inflation side of the problem is that if inflation goes up, which was their forecast, then the Fed should be hiking. And they are revealing their hand in the sense that they are putting in the dot plot that they do expect that rates will be going down. And he did also say yesterday that if we did have a deterioration in the growth outlook, we would be putting weight on that. But it really is bringing some very fundamental discussions at the moment, namely, Paul Volcker clearly did say inflation was going up. That's what we're fighting. But here, Powell is almost leaning a bit in the other direction of saying, yeah, we know that inflation is high, but if growth slows down, we will be looking at that as a key driver of our decisions. So that's why it is a very, very difficult spot for the Fed to decide, should they be hiking rates, should they be cutting rates when there's stagflation. I do think that they have told us that they will be cutting, but that comes with some risks, of course, to inflation, including also inflation expectations.
Why is the Fed chair, and indeed perhaps more members of the Fed, so convinced that any bout of inflation that we might see that would be directly or semi-directly thanks to the tariffs that might be put in place, that would be transitory inflation?
Yeah, Bonnie, that was a very important part of yesterday and very interesting. I mean, the fact that we are having a transitory discussion again, because the issue, of course, is that when we all talk about if the price of my avocado or my car goes up because of tariffs, it may be that this is only once, but that's assuming that there only is one set of tariffs. What if there's more tariffs coming? What if these tariffs are implemented gradually? What if these tariffs begin to have implications for inflation expectations? What if these tariffs begin to have implications for wage expectations? There are so many other domino bricks economically that you can begin to think about. How are they falling if there is just one shock from tariffs? So it's correct to say that the price of things would potentially only go up once, but all the side effects of raising the price of things are such that it could have a number of other, in many cases, unintended consequences for the inflation outlook, and therefore be something that could have a more persistent upward pressure on inflation.
Torsten, very briefly, why is the market pricing in 2 to 3, potentially even now swaps market pricing fully in 3 cuts this year?
Yeah, this is really interesting. Also, if I look at equities, they are down like at 10% of the correction. I mean, that's like saying, wow, the Fed is going to cut 10, 15 times. But rates markets are saying, no, hold on, inflation is still too high, so that's why the Fed is only going to cut 3, 4 times. And I think that backdrop, that difference between the sentiment being quite negative in equity markets about corporate earnings is quite different from the sentiment in rate markets, which is tending to put more weight on inflation. And that's back to the stagflation risk, namely the stack part of the outlook is that equities are worried about earnings, and the inflation part is that the Fed is worried about inflation being higher.
Torsten, thank you so much for all of that perspective. That is Torsten Salk of Apollo Management, and it is much appreciated. We've got a little breaking news now. Mark Carney expected to call snap elections for April 28th. This is according to the Canadian Globe and Mail. Once again, Mark Carney, who just took over from Justin Trudeau as leader of the Liberal Party, expected now to call snap elections for April 28th. And we do have the Canadian dollar weakening versus the US dollar right now. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
In case you missed it on the China show.
Compared to a 10% tariff on Chinese export to the United States, I mean, even the entire determination of the fentanyl industry in China is totally worth it.
I think this is a monumental moment for global AI development. DeepSeek did was not only just make the products free, but also they released the entire research open source so you can see how they did it. This has forever democratized this current most advanced version of AI.
How do your students feel about their jobs prospects?
There are a lot of opportunities in this AI application fields.
On the other hand, if you look at traditional manufacturing, I think the main problem is that there's a lot of mismatches between supply and demand.
Don't miss the China Show live every weekday.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Ukrainian President Volodymyr Zelensky agreeing to a proposal for a mutual halt to strikes on energy assets as an initial step in President Trump's effort to end the war started by Russia. For the latest, Bloomberg's Greg Sullivan joins us now from Dubai. So, Greg, Ukraine has agreed to this partial ceasefire on energy assets at least. What is the sense outside of the United States? Is it that this is a positive move towards a broader ceasefire, or are there other elements in the reaction?
Well, in some sense, Ukrainian President Volodymyr Zelensky just didn't have many choices. He's in a very tough spot right now. We've seen the White House heaping pressure on the Ukrainian side and acting in a much more conciliatory way towards Russia in terms of how the negotiations are proceeding and the concessions that they are demanding. If you remember, after that last White House meeting, the U.S. actually suspended military aid and intelligence sharing, which put Ukraine in a very difficult place because it relies on both of those. So in some ways, Zelensky had to come to the table and had to agree to something. The onus had originally been on Russia to agree to that 30-day truce, which they clearly did not. But agreeing to halts on military or strikes on energy facilities was something that both sides could agree to, and Zelensky basically had to show up and accept. Where it goes from here, though, is still a big question.
Yeah, and of course, EU leaders themselves arriving in Brussels ahead of their meeting today to discuss defense spending. What are we expecting to learn from that meeting?
Well, there's a few things at play here. One is that the meeting is really about translating these bigger and broader plans for taking hold of their own security architecture, defense spending, building out the defense industry into more concrete steps, to actual plans of action from just broad contours. But there's also concern among European capitals that they are being left out of the negotiations that Trump is pursuing for a ceasefire directly with Russia. So European leaders will also be seeking ways to maintain that relevance, to maintain that seat at the table, and make sure that their own security architecture is not decided without their input. And even more broadly, we'll see trade come up as Trump administration continues to roil trade markets with tariffs and talks of trade war. Europe really has to consider how to become more competitive. So all of that will be on the table at the summit, leading with Ukraine, of course.
All right, Greg Sullivan, thank you so much for joining us. That is Greg Sullivan there out of Dubai. Now to Washington, President Trump diverting from his administration's previous comments on the Federal Reserve. He's saying now that the central bank should cut rates to help his incoming regime of reciprocal and sectoral tariffs ease their way into the economy. Previously, his team has said that their focus wasn't on rates themselves, but just on the 10-year Treasury yield. So let's bring in Bloomberg's Kevin Whitelaw now, who joins us from Brussels to discuss this. Kevin, are we seeing the president return to pressuring the Fed chair? He had eased off a little bit, it seemed. Or are we expecting Powell to just shrug off these posts on Truth Social continually?
Yeah, I mean, you know, what we expect the pattern to be is that Trump is going to make noise and Powell is generally going to ignore it. But obviously, you know, the Powell is going to have some decisions to make down the line about, you know, whether he thinks his job security is on the line and whether or not that matters, you know, should factor into his own thinking. But for the most part, Trump has always had opinions about about interest rates. He's rarely, shied away from expressing them. So we know that Trump believes that those interest rates and the interest rate policy should be serving his policy goals, whereas obviously from the Fed side it should be about serving the broader economic health of the United States.
Well, his mind is obviously on tariffs, and he has said they are still coming. April 2nd will be the implementation day. India is going to be included in them now as well, according to Donald Trump. What is the latest on these tariffs? Have you any more insight into what we'll see?
You know, we are waiting really to see what these are going to look like. The numbers aren't clear yet. The range isn't clear yet. You know, Trump has said a number of different things when it comes to what these tariffs are going to look like. They're going to be huge. They're going to be gradual. They're going to be global. They're going to be, you know, and then some of his advisors have suggested that there may be some room for negotiation. So we are expecting variations across different countries and potentially across different sectors. And that's going to be a potential challenge for blocs like the European Union, who really try to tackle trade policy as a whole bloc. But if there's 27 different rates, that gets complicated. Trump has said that they're going to take into account so-called non-tariff barriers. This is things like the value-added tax in his mind, which really isn't a trade tool, but is just a straight tax. Having said that, depending on how this is all factored in, on top of those tariff rates, you're going to have this threat of reciprocal tariffs, which means that any kind of retaliation from other countries will then have a retaliatory automatic effect in the U.S., apparently. So all of this leads to a very uncertain situation, and everyone's waiting to see what the legal language is when it comes to these tariff proposals.
And Greg, just on U.S. economic data, we're going to get initial jobless claims a little later this morning, but obviously there's going to be a focus on federal jobless claims data, and that comes out after the market closes. Judges have been trying to force DOJ to turn over its records. What's the latest on the struggle by the states against Elon Musk's initiative?
Well, this really is an important court fight. There's a lot of court fights already underway, and there's going to be more. But this really is about access to information and access to just understanding what exactly the Elon Musk and his DOJ team are up to when it comes to their activities in the federal government. We have seen them make various kinds of recommendations and decisions almost about cutting programs, about suspending programs, but there's been no transparency really about what that actually has meant, what the process is, who's making the decisions, is it getting sign-off from folks more broadly in the administration, and that's the kind of access that these states are looking for. And so the real question is, who ultimately, if anyone, has the ability to challenge the kinds of decisions that are being made and make sure that they're actually following various legal protocols? And just as importantly, is the Trump administration going to act and feel bound by court decisions? We've already seen Musk, we've already seen President Trump challenge really the ability of these judges to try to step in. This really is a fight that I think we're going to keep seeing over and over and over, and likely will often end up in the Supreme Court.
All right, Kevin, thank you so much. That is Kevin Whitelaw for us out of Brussels. Now to a stock we're keeping our eye on, NVIDIA extending gains in the pre-market now, outpacing those of the NASDAQ 100 futures. And that's after snapping this week's decline already. This move is following news from the Financial Times that NVIDIA is planning a massive outlay on US-made electronics. For more, let's bring in Bloomberg tech editor Mark Bergen. Mark, Huang's comments to the FT come in the wake of other big US tech companies drumming up their domestic investments. Is this a bit of pageantry, do you think, for President Trump's America First policy? Or will investors actually see this outlay as a significant move and a positive move from the chipmaker?
Yeah, I think they'll see it as a significant move of pageantry. I mean, this is largely a political move, right? This is ingratiating itself with the administration. It is doing like onshoring. It's something they're continuing to work with their main manufacturing partner, TSMC. They just say down they're moving those resources to U.S. production rather than Taiwan. And you know, we haven't. There was no signal that NVIDIA was not going to come out and say what they've said in this past week, right? That we're launching a new chip. That they're seeing a lot more growth. They have this expectation about this continued spending on AI investment, which is, I mean, we've seen from their largest customers in Silicon Valley have said that they're going to continue to expand their capex. So I think this is a sign that maybe the Trump administration might go easy on NVIDIA. There is an open investigation from last year from the Department of Justice around antitrust.
Yeah, for sure. And then the other thing that was happening, it felt like all day long yesterday, was that Jensen Huang was trying to cool fears caused by DeepSeek surrounding the money going into AI capex. What exactly was his argument? Was it compelling to investors?
Yeah, I mean, to investors, sure, if you see the bump. I mean, I believe the stock certainly has recovered some from that major dip, like a record dip we saw in late January. The argument here is something that's consistent with what Microsoft and Google and Amazon have said. Okay, if DeepSeek has shown that they can produce a cheaper model than, say, the OpenAIs of the world, there actually will be an increase in AI spending, and there's still this kind of untapped demand. I think the argument that Wang made in part was we're misinterpreting the model. There's been some arguments that maybe that what DeepSeek did was kind of based off piggybacking on the work of others like OpenAI that have used much more computing intensive and much more NVIDIA chips. And so the logic there is that we're not going to see AI developers cut back on spending on chips. And to be clear, when they're spending on chips, they're spending on NVIDIA.
Yeah, exactly. Mark, thank you so much. And that is Mark Bergen for us. But don't miss our special Bloomberg Technology show out of San Jose and the NVIDIA GTC AI conference. That takes place at 4:30 p.m. Eastern, and you don't want to miss it. Now to other top stories trending on the terminal this morning. EQT will return $5.4 billion to investors this week after completing the sale of a stake in Nord Anglia Education. The investment was initially made in 2008 and was reinvested again in 2017 through a different fund. Sources say it has since delivered nearly 4 times its invested capital. A spokesperson in London declined to comment on the fund returns. Sources say cloud computing provider CoreWeave is seeking to raise about $2.5 billion in an IPO. The NVIDIA-backed company and current shareholders are planning to offer the shares for $47 to $55 apiece. It's expected to disclose proposed terms for the listing and begin marketing the shares today. A representative for CoreWeave declined to comment. New York City subway riders will no longer need that physical Metro card by the end of this year. Riders will instead be encouraged to adopt the already popular contactless tap-and-go payment system. The final day for Metro card sales and distribution will be December 31st, and the MTA estimates it will save at least $20 million annually in production and distribution costs. Coming up, more rate decisions and economic data in your day ahead. Context matters on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Now look at what's ahead today. The BOE's rate decision coming in at 8 a.m. Eastern Time, just more than 2 hours from now, and that's followed by Governor Bailey's news conference. Then U.S. initial jobless claims coming at 8:30 a.m. Eastern. They'll be watched very closely after the Fed decision yesterday. Existing home sales at 10 a.m. Plus, we'll get earnings after the market close from Nike, FedEx, and Micron. Some analyst calls this morning. KKR raised to overweight at Wells Fargo. Price target there, $141. FCX, Freeport McMoran, raised to overweight at JP Morgan. The price target there, $52. And you might want to keep an eye on Southwest as well. Raised to neutral at UBS. The price target there, $36. As you can see, very close already to that price target. Let's take a quick look, though, at the 10-year yield. Arguably, the 2-year yield is the one that's more in tune with what the Fed is saying, but the 10-year yield shows it very, very clearly. That big drop in the last day and a half since we got that Fed decision and those comments from Fed Chair Jay Powell about any potential tariff inflation bump being transitory. Well, you have the market pricing in more cuts, and that 10-year yield now down 10 basis points since those comments to 422.16. That's it for Bloomberg Brief. Surveillance is ahead. Context matters on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
Everyone's relieved that the Fed didn't jump to significant conclusions.
If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year.
I don't think there's any chance that they cut in May.
The question is how much of a growth deterioration needs to occur before the Fed can react, and it seems to be that the bar is pretty high for that.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday with equities struggling to build on yesterday's bounce as Fed Chair Jay Powell downplays inflation risk.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation.
So Team Transitory is getting the band back together, preparing to look through any potential bump in inflation, and the president wants them to go even further, writing the Fed would be much better, cutting interest rates as tariffs start to ease their way into the economy. The president calling April 2nd Liberation Day.
At a time when they're hoping to get long-term rates lower, Kevin Hassett also speaking yesterday after the Fed decision said that Fed officials are, quote, a little tighter than they want to be, than they would want to be at equilibrium right now. They've backed away. Let's be very clear. This isn't a Fed that's necessarily under that much political pressure at a time where they're using the T word to talk about tariffs and the potential ramifications for inflation.
There is a bullish interpretation. There is a bearish interpretation. We debated this extensively yesterday afternoon. The bullish interpretation goes something like this. Inflation was revised higher, but the median dot didn't go up. The bearish interpretation is that growth was revised lower, but the median dot didn't go down. This market is putting a lot more weight on one versus the other, reinforced by the message from Chairman Powell.
That's right. And what you're seeing right now happen is, I think a lot of people are trying to understand how the Fed views inflation, because they're ciphering off regular inflation that was already there and they were trying to quell, and this quote-unquote tariff inflation. And I remembered yesterday thinking about what Scott Bessent, the Treasury Secretary, said to us around this table, thinking of getting the band back together. He said, Team Transitory, if they have any credibility at all, they need to look through the one-time price adjustment when it comes to tariffs.
Yesterday's decision, the inflation growth policy mix of the forecast, will take on a life of its own at 8:30 Eastern Time. When we get more data, how will this market respond if we get a deterioration in the economic data, specifically jobless claims at 8:30?
Do they get the sense that this Fed will have the markets back and respond to weakness possibly as soon as May if we do get a sign that that unemployment rate is reaching their target of 4.4% more quickly than otherwise expected? I will just say part of the reason why people are dismissing the hawkish interpretation is because Jerome Powell himself came out and said, you know, with respect to the dots, what would you write down? It's really hard to know how this is going to work out. So if they're telling you, we have no clue, we're in a dark room, we're just guessing, but we are looking at transitory inflation and weakening growth, well, that's the reason why people see Dove.
Also, the fact of the matter is, they kind of took a hike off the table. And if you're trying to quell inflation, you would need to hike. This quote, we're at a place where we can cut or we can hold. It's what he didn't say that I thought mattered.
Equities this morning struggling to add to yesterday's bounce. We are slightly lower on the S&P 500, just dipping into negative territory in the last few minutes or so. Coming up on the program, we'll be catching up with Julian Emanuel of Evercore as the Fed triggers a rally in equities in the last 24 hours. We'll speak to the former ambassador to Switzerland, Ed McMullen, on President Trump's tariff agenda, and Ian Steely of JP Morgan Asset Management as Chair Powell brings back the T word. We begin this hour with stocks struggling to add to a post-Fed relief rally. Julian Emanuel of Evercore writing the following. In a Washington where policy uncertainty is swirling, Chair Powell projected a sense of calm and confidence in the eye of the storm. 2025 is a volatile. 3 steps forward, 2 steps back. Julian Emanuel of Evercore joins us now for more. Julian, good to see you.
Good morning.
How many steps forward or back did we take yesterday?
We took a half a step forward. Look, this process, and we think that this is a correction. We are in a bottoming process. The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds, because as we've seen, and Powell pointed out a week and a half ago, the soft data, the confidence, the opinions are all very cautious. The hard data has started to show signs of cracking, but nothing that, as he said yesterday, is significant at this point.
Yeah, I wouldn't say dismiss the soft data, but he certainly downplayed it and played up where the hard data still was and how decent, healthy the economy still is. The question I would have for you as an investor right now, Julian, is whether the easing bias would be constrained if we got a deterioration in the economic data, whether that easing bias is constrained because they'd be worried in any way, shape or form about higher inflation.
I don't think that's the case. Look, the academic research, and if you go back to the trade wars in 2018 and 2019, let alone going back to the last great tariff era, the 1930s, we'll only mention that once, is that basically inflation was not a concept. Inflation moderated into 2019, and the expectation, and maybe it was an unfortunate choice of words, transitory, but maybe it was intentional to really make a point here. The bigger question is that when you think about it, to your point, John, is that the projections for growth are not consistent with a pro-growth president's agenda over the long term.
That said, you said a half step forward. Is it a half step forward for risk assets if essentially this is a Federal Reserve saying that they are expecting stagflationary-like environment in the near term, which by all accounts has traditionally been terrible for risk assets?
Well, and again, it just goes back to questions of degree, right? So remember, prior to the pandemic, we were thinking that the economic numbers that the Fed is projecting was basically the long run, rate of growth. And in fact, they reinforced that. I suspect they prefer to think that the number is closer to 2%. And so from that point of view, it's not necessarily the stag part as much. But again, the whole point here is that the policy disruption we've seen puts the mood such that, you are at that fine line.
You said that maybe it was an unfortunate use of words with transitory. It seemed pretty deliberate. He repeated it several times, and he seemed pretty confident when he said it. He didn't back off from the T word. He embraced that T word. And I wonder at what point we're looking at a revision of what we saw previously, where that word was inaccurately used at a time when you've got a global fiscal impulse that is pressuring yields higher and potentially going to keep inflation at a higher level, just de facto, not only before the pandemic, but more in general, simply because of how many dollars and euros are in the system.
No, and there's no question about it. That when you go back to think about the last month, is that the geopolitics of the situation, really caused this fiscal impulse that we see now is going to be the long-run trajectory in Europe, and that's a different set of circumstances and calculations that, if anything, puts a floor under long-term yields, which might be something that the administration wasn't exactly banking on. But again, it comes down to this idea that policy implementation, and this is why, in our mind, how the messaging on April 2nd is so very important, is that you've got to provide, room for the art of the deal to work, not the sledgehammer, the art of the deal, because confidence is fragile now.
Why do you think it's not going to be a sledgehammer, given everything we've already seen from President Trump? You think April 2nd is going to be a blueprint?
I think, again, if you look at it, they say they aren't as focused on markets. That may be true because they did tolerate this drawdown recently, but there's definitely an eye on markets, and there's a knowledge that there's only so much that you can really sort of do in so compressed a time without tipping the confidence into something where the hard data starts to deteriorate.
They've already acknowledged that they're in negotiating mode. Kevin Hassett said that he was recently this week working with Howard Lutnick, the Commerce Secretary, Scott Bessent, the Treasury Secretary, with other countries to potentially negotiate reciprocity before April 2nd. So in that case, you think a Trump put still exists?
So the Trump put, Fed put, these are just terms, quite honestly. The bottom line is, whether you're the Fed chair, the President of the United States, or a head of a Fortune 100 company, there's no question about the fact that over the last 30 to 40 years, the link between the equity markets and the economy is inextricable. It's very, very infrequently where there's any kind of divergence. And because prior to the pandemic, there'd been this consistency where the soft data would lead the hard data, You know, the question is, are we returning to that mode? It's not clear, but we don't really want to take that risk.
All right, if we took a half step forward to yesterday, maybe not in resolving all the uncertainty, but maybe following this bottoming out process, are you getting materially more bullish right now after yesterday's Fed meeting?
Well, the concept of materially more bullish when there's as much uncertainty as there is out there has to be guarded, okay? So what we're doing is we're saying it's time to rebalance your portfolio, add, you know, essentially, if you're doing, you know, portfolio adjustments, this is the dip you want to buy. This is not hand over fist kind of stuff. We've sort of switched out of our low volatility stocks. They've done incredibly well. We're adding a little bit more risk. We like the AI theme long term. We think what we've heard the last couple of days is very positive. But this is tempered because this is not an off to the races situation by any means.
Let's finish on this, a phrase we hear a lot of, wait and see. And yesterday we were asking, how long do you need to wait before you see? How much time have we actually got to wait for? To see whether this link is still well established between the soft data and the hard data. Because the soft data has clearly deteriorated. And as I said, I don't think that the chairman yesterday dismissed it, but I think he certainly downplayed it. How much time have they got?
Well, isn't that old saying April is the cruelest month only because we have to pay taxes in April? I think April's very important. It's very important. And if you think about the fact that the conflict in Europe and the conflict in the Middle East have, if anything, intensified in recent days, it's time to put some wins on the board. April is very important.
Lisa gets hers done in March, just so you know, Gillian.
I do.
I know.
Well, is that actually early? I thought that I was kind of late.
I wish I was a March kind of guy.
Are other people like April 14th?
First week of April.
Really?
Like the day before.
Really?
Every single time.
But that gives me anxiety.
No, March is early. March is good. Good for you. Julian Emmanuel, Julian, good to see you. Equities, by the way, just erasing some of those gains from early this morning in the European session. Equity futures, as New York wakes up, taking a bit of a dive. We're down now by 0.25% on the S&P 500. We'll keep track of that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. The Federal Reserve left interest rates unchanged for a second straight meeting, but President Donald Trump seemed to disagree with the move. In a post on Truth Social, he said the Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy. The Fed's next meeting is May 7th. Ukraine President Vladimir Zelensky agreed to stop hitting Russian energy assets as a first step toward a ceasefire with the country following a phone call with President Donald Trump yesterday. According to a statement on the call, Trump also offered to help run Ukraine's electricity and nuclear facilities, saying American ownership would be the best protection. And over to Canada, Canadian Prime Minister Mark Carney is expected to call a snap federal election on Sunday for an expected vote on April 28th. The Globe and Mail reporting the move comes as Canada's Liberal Party takes the lead in some public opinion polls on the back of Carney's rise to PM. That's your Bloomberg Brief. John?
Massive turnaround for that party in the last few months, that's for sure. Yahara, thank you. More from Yahara later on this hour. Up next on the program, the T word makes a comeback.
I think that Chairman Powell was clear that if there were a tariff effect, that it's a transitory one, and that's in every economic model. I just think that the tariff effect is probably zero or negative.
That conversation up next with Rob Casey of Signum Global Advisors, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Equity futures taking a bit of a dive here. We're negative by 1/3% on the S&P, taking a small bite out of yesterday's rally. This came from Stuart Kaiser of Citi. The March Fed pleases markets. It confuses us. Confused others too. This morning, maybe Stuart isn't confused. The Nasdaq is down by 0.5%. The Russell down by 0.5. Under surveillance this morning, the T word makes a comeback.
I think that Chairman Powell was clear that if there were a tariff effect, that it's a transitory one, and that's in every economic model. I just think that the tariff effect is probably zero or negative. We very much respect the independence of the Fed, and there's a massive literature that independent central banks perform better for economies.
So here's the latest this morning. The White House backing Fed Chair Jay Powell's call that the inflationary impact of tariffs could well be transitory. President Donald Trump going one step further, calling for the Fed to cut interest rates. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, welcome to the program. Actually, on this issue, and it's a key issue, the Federal Reserve and the White House seem to be on the same page.
Yeah, John, at this point, looking ahead, saying that this might be short-lived impacts when it comes to the transition that this administration keeps pushing ahead. Important to note that President Trump has long said that he would like to have some sort of influence over those FOMC decisions previously floating, for example, that he could have some sort of comment period, even as we hear his senior administration advisor saying that they do respect the Fed's independence. But really what's at the crux of the issue here is that Powell did say that we are already starting to see those tariff impacts on the economy and economic projections, and we haven't even gotten the full scope of the White House's plans yet. You mentioned it there, that Truth Social post. President Trump keep pushing us towards that April 2nd date where there are still so many questions about the scope and the implementation. In a bid to try to get more answers, I actually had my own chance to catch up with Kevin Hassett yesterday at the White House, and I asked him about the timeline for those April 2nd tariffs. How long will it take for us to actually see them go into effect? And he told me that the working assumption would be that those April 2nd tariffs would actually go into effect immediately in a bid to reduce uncertainty. Those were his words, as well as to get ahead of importers potentially front-loading goods into the country in between a tariff announcement and implementation. Of course, John, we've heard different things from different administration officials, including that this could be more of a rolling process over a few months. Kevin Hassett did add that that expectation he outlined to me was, of course, subject to the constraints of Customs and Border Patrol.
Tyler, he also recently said that he's been working with the Commerce Secretary and the Treasury Secretary with other countries to try to get negotiations done before April 2nd. What countries are they looking at?
Right, well, new reporting that India is apparently coming down when it comes to their own tariffs. But we know, according to our Bloomberg News reporting, that these tariffs could really be subject to how President Trump is viewing the negotiating process when it comes to countries being either cooperative or combative. And that is going to be incredibly important going forward. Just yesterday, President Trump ramping up his attacks again on how Canada has been approaching this process. Importantly, I did have the chance to ask Kevin Hassett also what sort of exemptions or carve-outs there could be. He said again that how the formula is going into effect, we are not expecting any carve-outs come April 2nd, and that when it comes to exemptions, it's really going to be based on how low those countries do end up putting their tariffs, and then, of course, the U.S.'s response would be reciprocal.
Hey, Tyler, appreciate the update. More from Tyler later on in the program. Tyler Kendall down in Washington, D.C. With us around the table here in New York City, Rob Casey of Signum Global Advisors. Rob, good morning to you. Let's start with the good news and the bad news. The good news is that this Federal Reserve seems to agree with the White House that if we get an inflation bump, it will be short-lived. And You could see that in the forecast beyond 25, into 26, into 27. The bad news, I think, for anyone trying to run the government, you never really want to see the Federal Reserve come out and downgrade growth forecasts and increase the outlook for inflation. What was your response to yesterday?
Well, I think yesterday what we read first and foremost, right, is that there just is this level of uncertainty. And so I think that the Trump administration is getting to April 2nd as quickly as they can, right, because they do want to set out a path for tariffs, essentially to allow markets, to allow the Fed to bake expectations in. The issue with that is the tariffs that they're talking about, reciprocal levels, about, tariff policy, but also non-tariff policy, things like VAT, it's going to be really hard to match those levels on April 2nd. So, great segment from Tyler, and it sounds like Hassett at least expects the tariff implementation to be April 2nd. We don't think so. It's just too quick a turnaround time.
How long do you think for the tariffs actually then to, maybe we'll have the blueprint, but to actually be implemented?
Well, I think it'll depend country by country. So I think rolling is probably a good expectation, right? It'll first and foremost depend on the countries that are willing to bring their tariffs down, right? I think those will be potentially the first announcements that we see, right? There's this idea that it's not so much that tariffs will go into effect on April 2nd and then we will have negotiations. It's that the negotiations are happening now, right? So whatever we hear on April 2nd, honestly, I wouldn't be surprised if the first truth we get on the morning of April 2nd is this is a win, right? Because we're not implementing tariffs on, say, India. Later on, I think we will see implementation more so across the board, but in particular on Europe.
So what you're saying is the negotiations are happening now. April 2nd is the day we get certainty, and then a few months later, we'll get the enforcement?
Well, I don't know if we're going to get absolute certainty on April 2nd, right? I wouldn't want to be held to that. But I do think we will get a relative certainty as to what countries are going to be tariffed over the course of maybe the month after April 2nd, right? It'll be a question of these are the countries that we are now targeting, and we are working to implement certain levels per country.
Do you think that's going to concern the administration? Because the markets are going to view that as more uncertainty. We're just living in this paralysis.
Well, it hasn't concerned them so far, right? So I would say to expect full 100% clarity and certainty on April 2nd, and to expect that we don't get movement after April 2nd is probably wishful thinking.
There's another sort of fly in the ointment here, which is what actually gets through. There are certain legal challenges that have been ongoing to a lot of what Trump has tried to do. And a number of the celebrations and the victories that President Trump has announced have been walked back or have had a little bit more of a complicated profile. How much of what we're going to see on April 2nd is going to be enactable in the short term, let alone the long term, just within the legal frameworks that there are?
Well, the executive has very wide latitude under IEPA, right, the Emergency Economic Powers Act. So I think for the most part, we could see some court challenges. But, I mean, IEPA essentially gives Trump all the leverage that he needs, all the power that he needs to enact these tariffs country by country. It may not give him the leverage to enact a universal tariff, right, but that's not what we're talking about.
Is there a recognition within the White House that it is important to create some certainty right now, given that everyone around the world is talking about uncertainty, and that word is the new drinking game? Is there a sense that this is actually becoming more of a problem rather than a feature?
Well, I think it's a problem for markets, right? But it's a feature when we're talking about Trump. If foreign policy, international policy, right? Trump is he uses the idea that he's kind of this crazy man in the White House, I think, much to his advantage, right? And it's not to say that his decisions or the announcements that he makes aren't rational, right? I think there certainly is a policy and a strategy behind them. But for countries to not know what his next move is, I think benefits him more than it hurts him.
When you say IEPA, though, that's a national security lever they need to pull. They're talking about, when they talk about messaging on tariffs, reciprocity. You can't use IEPA for reciprocity, or to Lisa's point, it will end up in the courts.
Well, I think it very well could end up in the courts, but the argument the Trump administration has made time and time again, right, is that the U.S. economy is being taken advantage of. It's being taken advantage of by allies. It's being taken advantage of by adversaries. And so I think that there is this sort of link between protecting the U.S. economy, protecting the U.S. worker, and, what we might more traditionally think of as being national security.
I know the spring's about to start. Blue skies. Can we take a more constructive view? What are the chances that the Europeans come out and say, I think we can make a deal here. We'll drop our tariffs on autos for you. Let's level things out. Let's do exactly what you want to do. What are the chances of that actually happening?
Well, I like the sound of that.
I love the sound of that.
And maybe on autos, there is, potentially a bright spot, right? But I think one of the major issues is the intractable concerns between Trump and the Europeans are not things that the Europeans are willing to give on, right? We're talking about CBAM, we're talking about steel and aluminum, Boeing, Airbus, digital services tax is another important one, right? These are things that the Europeans are ideologically committed to. equal and opposite the way Trump is ideologically committed to either removing them or punishing them.
Rob Casey of Signum Global Advisors. We're getting closer and closer to that April 2nd date, and I'm with you both. I think I'm with a lot of you watching this program as well. Will we actually get any clarity on April 2nd? Because this might take some time. It might take a while.
We might get the rollout on April 2nd, but to Rob's point, the implementation might happen and the enforcement might happen weeks or months down the line. Remember, depending on how they enact these tariffs, IEEPA can be day one, but you go 232 or 301, there has to be a public comment period, and that can take a long time.
Something about what Rob just said really struck me, which is it's a feature for this administration to have uncertainty when negotiating with some of the countries around the world. It is a bug for markets. And at what point does some of the uncertainty in markets create something of a bug for the administration in some of the raw data coming out from the domestic sphere? And how do they expedite the timeline where it can be a feature for the international negotiations? It's sort of two separate wheels that are spinning at the same time.
The short answer, not yet. They don't seem to be too deterred by what's happening in financial markets, or for that matter, the economic data. And I'd go as far as saying the chairman agrees with them. Chairman Powell yesterday in the Federal Reserve pretty much echoed everything we've heard from the administration over the past few weeks.
With one exception, increasing the rate of unemployment, although they did talk about a level of uncertainty, and increasing inflation. And this also is something that they don't want to see, at least not this year.
A one-off bump. We'll see if it's a one-off bump. Equity futures right now in the S&P negative in this session lows. We're down by 0.7%. Up next on the program, Ed McMullen, former U.S. ambassador to Switzerland, on Trump's tariff policy.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big. With $1 trillion of assets almost, we're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures here on the S&P 500, negative by 0.7%. We're taking a bite out of yesterday's gains. Check out the NASDAQ. We're now down by 0.8. Peter Cheer of Academy saying this yesterday. This year's dots seem to solidify. We're at 2 cuts max for this year, rather than at least 2 cuts. That may weigh on markets in the coming days. That's an interesting way to frame this. If you look at the dots and the distribution of the dots, we have moved from at least 2 cuts to maybe 2 cuts max. And Lisa, that's a shift.
There is a larger question of how much of a signal can we get from the dots. Some people could say that they still have 2 dots priced in, even with potentially higher inflation, is dovish. Other people say the fact that there are only 2 dots and that's the max, is that somewhat hawkish? The takeaway is they don't know, but they're projecting higher inflation and lower growth, and that potentially is a problematic mix for risk assets.
We had this debate yesterday, and we could have this debate all morning.
We don't have to.
If you were on the Federal Reserve, we could. We probably should. Maybe for a minute. 60 seconds, 60 seconds.
Carry on.
If you're on the Federal Reserve and you put out those forecasts yesterday, would you have anticipated the equity market being up as much as it was? Because the former Boston Fed president, Eric Rosengren, was out on Twitter, X, just yesterday, and said that members of the committee saw more risk of upside to inflation and more risk of downside to growth. The market may have reacted too much to no change in the rate forecast, but the heightened risks are more consistent with stock market declines. There was some pushback to that bullish interpretation in yesterday's session.
Certainly, it sort of was a surprise to see markets rally the most for a Fed day going back to July. A question, though, from Amanda Lynham. How much was that already priced in? This idea of slightly slower growth, slightly higher inflation. We've already seen Wall Street firms from around the world really come out with that kind of projection. The Fed was saying the transitory aspect, and that probably was the biggest part of that, saying they're going to look through a one-time bump in tariff-related inflation, and that gave people confidence they were going to place more emphasis on downside growth.
Will this market look through it? Check out the bond market, 2-year, 10-year, 30-year. Yesterday, yields dropping at the front end of the curve. That continues, down another 2, 395 at the very front end of the curve. But check out the commodity market. Lots of reasons for copper to be back through 10K. Gold, another all-time high in yesterday's session.
Watch this space. It is the hedge against absolutely everything, whether it's stagflation, whether it's central banks that are trying to diversify away from the dollar, whether it's something of a downturn when it comes to economic growth. And so for all of those reasons, people have been going into gold. At what point does that have to stop rallying for the risk asset rally to really get back up and going?
Gold just a little bit lower today. We're down by 0.7%. On our radar this morning, our top story, the financial markets worldwide. Fed Chair Jay Powell saying the impact of tariffs may well be transitory. President Donald Trump going a step further, calling on the Fed to cut rates with reciprocal tariffs set to take effect on April 2nd.
So what's so interesting about this is exactly what Scott Bessent, the Treasury Secretary, told all of us around this table a month ago. He said, get the band back together. If Team Transitory wants to look at tariffs, that they should look at it as what it is, a one-time price hike. Something interesting, though, Jay Powell said yesterday, was that when you looked at the tariffs in 2019, things like washing machines had tariffs placed on them, but things like dryers didn't. Still, you saw prices elevate. And I think that's what they're concerned about. Whether or not that those individual objects, those individual imports have tariffs on them, the entire supply chain could get a one-time price hike.
That comment by President Trump didn't have a lot of bite behind it. And a lot of people didn't give it a lot of credence that suddenly, will he fire Fed Chair Jay Powell? That seemed to be off the table yesterday because it sounded like Fed Chair Jay Powell was taking very much a page, to your point, from Scott Bessent. It sounded like he had been having lunch with him every week, like they are wont to do. And he listened to what he had to say. He said, okay, let's get Team Transitory back together. The band is here. We believe you. We believe your projections. At a certain point, you have to wonder, are they out of the scrutiny now of the president and now under the hot lights of data that is very complicated, and that has to be the concern for markets.
We get more data later on this morning, 8:30 Eastern Time for jobless claims. Let's get you the latest on foreign policy. The Ukrainian President Volodymyr Zelensky backing a ceasefire on energy targets with Russia. The agreement coming after President Trump spoke with leaders of both nations earlier this week. More ceasefire negotiations are expected this weekend over in Saudi Arabia.
So Steve Witkoff said this to us yesterday. He said the technical teams will be going there. Overall, it looks like there is this pathway to peace. When it comes to the technical teams, though, Mexico, there's going to be a lot of different policies they need to negotiate, security arrangements they need to negotiate. Something I picked up yesterday off this readout. President Trump said he discussed with Zelensky electrical supply and nuclear power plants. And then Zelensky came out and said they're looking at Zaporizhia. This is Europe's biggest, most important nuclear power plant. It is in Ukrainian territory, but it's the Russians, since most of the war, that have had control over it. Potentially, this is where deals can be done. If the U.S. were to come in and say, we're going to be the ones that operate it, in essence, that would be in a security arrangement.
Can we make some progress here? We hope so. We're certainly making some progress on this front. Some more good news for the administration. NVIDIA looking to spend hundreds of billions of dollars on U.S. chip manufacturing. The CEO, Jensen Huang, telling the FT, investment will ramp up over the next 4 years in an effort to shift supply chains away from Asia in the face of President Trump's tariffs.
Fascinating, especially because what he said is not only is it tariffs, but it's also a national security issue with respect to Taiwan. This from Jensen Huang. We know that we can manufacture in the U.S. We have a sufficient diversified supply chain. If any disaster were to threaten production in Taiwan, he said, it will be uncomfortable, but it should be okay. I just have to go back to this. How much is this a direct response to tariffs, and how much is this just girding for whatever increase in geopolitical tensions there are between China and the U.S. and what that could mean for Taiwan?
NVIDIA's down in the pre-market by close to 1/3 of 1%. Let's talk about those tariffs. Just 13 days to go until President Trump's threatened reciprocal tariffs go into effect on April 2nd, including a 200% levy on European wine, champagne, and spirits. Ed McMullen, the former U.S. ambassador to Switzerland, joins us now for more. Ambassador, it's good to see you, sir.
Jonathan, good to see you.
Can we avoid the tariffs on wine, spirits, and champagne?
I hope so.
What are the French telling you?
Tragedy, right?
I've been stockpiling.
You spend a lot of time in Europe, sir. Walk us through what they're saying to you, how they're responding. Maybe draw a distinction between what officials are saying and what business leaders are saying.
Yeah, I think it's very important because the reality is I was on a trade mission, a private trade mission over in Switzerland and Italy. And when you talk to the governments or you hear what the governments are saying, it's very different from what people are saying. Met with over 80 CEOs over the period of 5 days, 6 days. Without fail, every one of them has a long memory and they understand the history of where we are. 2018, 2019, Mr. Emanuel or earlier referred to this. We've been here before. We know where the president's coming from. He's been very clear on reciprocity and demanding reciprocity on tariffs. I think every single CEO who was in those rooms understands the reality. The economy rebounded in ways we've never seen. It was generational success. President Trump did it in 1819. Scott Bessent is an amazing asset for the president on the economy. He adds stability, he adds insight, and I think we're going to see an amazing recovery, just as we did in 18 and 19, and one I think that will be unprecedented.
I imagine you were very popular on that trade mission because I imagine every CEO wanted to know what can we expect on April 2nd. Do you think that it's going to be a sledgehammer when it comes to tariffs or a blueprint?
Yeah, it's a great question. I think, though, we can look at history, and President Trump is very predictable. He makes it clear what he's going to do, and he does it. Lisa just said this earlier. This is a clear message to the world that we're done being taken advantage of. Reciprocity is the key. What I told business leaders is your job is to make sure that your government, not the Brussels bureaucrats, but your government, sovereign nations, make clear where you stand on reciprocity. The Swiss, 99.9% of their products are not tariffed. They are reciprocal. The Italians, similarly, working hard to ensure reciprocity. Maloney, fantastic leader. She's dedicated to a relationship with the U.S. on trade like no other. These are two countries that I think are the shining stars of Europe. The rest of Europe that's following the Brussels bureaucrats are the ones who are going to have the problems.
Well, speaking of that, the president spoke to Breitbart yesterday, and this is what he said. The ones that wouldn't be as friendly to us in some cases treat us better than the ones that are supposed to be friendly, like the European Union, which treats us terribly on trade. So what are you saying right now, when we get reports that Kevin Hassett, Scott Bessent, Howard Lutnick are dealing with countries, it is on a bilateral basis, not the European Union as a trading bloc alone?
Well, I can't comment on what they're doing in a bilateral relationship. I can say this. In my experience, we have seen very clearly business wants there to be a bilateral conversation between sovereign nations, because those nations independently have a message to give. The European Union as a whole is truly controlled by a group of bureaucrats in Brussels who have no clue what's going on back home 1,000 miles away in Hungary, in Poland, in Switzerland. This is where the bilateral relationship and the bilateral negotiations, and Jameson Greer, I have to say, is a fantastic guy. I worked closely with him while I was ambassador, does a great job. He worked with Lighthizer. He understands the president's message. We all understand there is a history here, a road path to success. Scott Bessent's laying it out. I think the president's laying it out. And I think we're going to see short-term, the same thing we saw in 1819, short-term challenges, but the terror of tariffs, I think, is more clickbait than it is reality.
When you look at history, though, we did see exemptions, we did see carve-outs. Do you expect that this time around?
I'm not quite sure where we're going with that. I think April 2nd will be a good indication on bilateral reciprocities. I think individual companies are critical. I know in Switzerland, where I was experienced, the average job is $130,000 a year. There are 300,000 of those jobs in the United States. We cannot risk those jobs and those investments. And I can tell you this too. Those 80 CEOs, they know where the growth markets are. They're not in Europe. They want to be in the United States. They want to be investing. So I think they have been given an incentive by President Trump to once again help the recovery in the United States, because as the U.S. goes, so goes Europe, so goes the world. And I think that's the real opportunity for these business leaders, and they know it.
From the business leaders who I speak to, the terror and tariffs isn't just some of the headline risk. It's the lack of understanding what the ultimate goal is.
Yes.
There's this question of bringing back manufacturing to the United States. There's a question about raising revenue to offset some of the tax cuts. And then there's a question of just trying to, create reciprocity and even things out that could potentially even lead to lower tariffs going down the road. It just is confusing when you see some of the relationships with Canada. What did Canada ever do to the United States? And suddenly that's our biggest fight right now at a time where there potentially are bigger fish to fry.
Well, I think the president dealt with Canada and Mexico in the first term. And I think they've recovered from that, and they've gone in a different direction, and we're trying to bring them home. That's what President Trump's working on. And frankly, Canada actually on several fronts has got some issues that we have to deal with. The president's working on it. They're an important partner. They're on our border, as is Mexico. And I think the president's clearly shown that he's willing and really focused on making those relationships work. You go through difficult times in any negotiations to get to positive, right? And I think that's where we are right now.
What do you make of the timing of going at Canada at this point, before we have an election? Because I can imagine a scenario where if the Conservatives had won, and they may well still win. That election is at the end of April, reportedly set to take place. That snap election could be triggered by Prime Minister Carney later on today. The Conservatives are in a really strong position with a 20-point lead. Poilievre could have been the next Prime Minister of Canada, still could be. And he would have been a fantastic partner for President Donald Trump. You could have had this North American powerhouse that was going to deregulate everything around energy, low energy cost, accessible energy, et cetera, et cetera. And you've seen what's happened. This fight between Canada and the United States has started. Sentiment has shifted in Canada, and the support has gone back towards the Liberals. How does that help the cause of the United States?
I had a great conversation with the former ambassador, President Bush's ambassador to Canada. And I can tell you from what I've heard is the real people back in the homeland in Canada, throughout Canada, they understand that the policies of labor have really hurt them over the years. That's the fundamental reality. That's what we dealt with in this last election. Americans, many of whom have never voted for a Republican, came out and voted for President Trump. I think we will see similarly the same situation with the Conservative government in Canada, based on what I've heard from ambassadors who are there on the ground, who continue to work with Canada. Canadians love Americans. They travel here. They know we're a critical partner. And we go through ups and downs like any family.
Do you think we're risking that relationship?
Not at all. I think the president knows the importance of it. And I think it's time that the Canadians understand the importance of it. The Canadian government. The Canadian people understand it. It's the government, the leftist government in Canada, that has been the problem. It's the reason Canada has suffered the problems they have. And I think reciprocity is the key. That's what trading partners and neighbors do. They have reciprocity if they want free trade.
Ambassador, always appreciate getting time with you.
Jonathan, great to be with you.
To get a better understanding of the world. The former US Ambassador to Switzerland there, Ed McMullen. Canada in focus in a bigger way over the last few weeks.
booing us at hockey games. Although Ambassador McMullen is saying that the relationship, like any family, I guess it's like one brother booing another brother.
Do you get booed when you walk into the house?
I'm not a brother, but I have seen some really interesting antics at home. Look, there is this question about sequencing. There's a question about goal. There's a question about just how to go about doing it. I think that what remains to be seen, and what I think a lot of people are looking for on April 2nd, is what are the metrics needed to strike a deal? And right now, we don't have a sense of that. If that can be achieved, that could create more clarity.
Well, when it comes to Canada and Mexico, also, most people I talk to think this is just the beginning, opening salvo to bring up the negotiations of the issues that the current administration has with USMCA.
Trade very much in focus. Equities, by the way, softer here. We're down by 0.75% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here is Yahara Hakez. Hey, Yahara.
Hi, John. President Trump is set to sign an executive order this afternoon to dismantle the Department of Education. Sources telling Bloomberg the order will direct Education Secretary Linda McMahon to, quote, return education authority to the states. Elon Musk's social network X has raised close to $1 billion in new equity from investors. Sources telling us here at Bloomberg the company is considering using some of the proceeds to pay down its remaining debt load, and that even Musk himself participated in the deal. And Finland has been named the world's happiest country for the 8th straight year. The U.S. fell to 24th place, its lowest ever level in the global ranking. The study by the Wellbeing Research Center over at the University of Oxford is based on a 3-year average of a population self-assessment of its quality of life. That's your Bloomberg brief. John?
If you've ever met Alexander Stubb, the leader of Finland, you'd understand that. Always happy. Always in a good mood.
And he seems so healthy. He
right?
Always, yeah, just
I think he's a cyclist.
100%. They're all cyclists. They're all triathletes.
It's those Nordic countries.
Let's move to Finland.
Pretty impressive, isn't it? Up next on the program, Team Transitory gets the band back together.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored.
Up next on the program, Ian Steely of JP Morgan Asset Management, live from New York. You're watching Bloomberg Surveillance.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. Nobody does that. They say, let's talk about the team.
And so many more.
Do you need a clap?
No, I think we're
Go.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Stocks up 1% yesterday, taking some of that back this morning. Futures lower across the board. On the S&P, negative by 0.6%. On the NASDAQ, we're down by 0.8. Under surveillance this morning, Team Transitory gets the band back together.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
So here's the latest this morning. Fed Chair Jay Powell downplaying tariff concerns, saying the inflation impact might well be transitory. Ian Staley of JP Morgan Asset Management writes, we believe the Fed will be able to respond with more aggressive rate cuts if the labor market falters, even with inflation still above target. Ian joins us now for more. Ian, welcome to New York. It's good to see you.
Thanks for having us.
I think you've nailed the most important point for financial markets right now. Are they constrained? Can they respond if the labor market data weakens over the next several months? What gives you the confidence that they can?
I think if you take a step back and think what happened back in 2018, the response was that they waited a little bit, and they probably waited a little bit too long, but ultimately they then reacted. And Jerome Powell was absolutely right. That was a period where inflation was transitory, where it didn't have a huge impact, and actually it was the growth and the labour market that was more critical to them. And I think that will be the case this time. And I look at it from the way, if you think about what they did yesterday, growth forecast revised down both years, inflation forecast revised up 1 year. Next year, they don't actually see much of an impact. So I do think they're going to look through it, and if they start to see really weak payrolls, that's when they're going to react.
I'm with Stuart Kaiser. I found yesterday deeply confusing and deeply contradictory, because on one hand, they were talking about how they're downgrading growth and they're going to look through inflation. On the other hand, Fed Chair Jay Powell seemed to dismiss some of the soft data that indicates weakening, which suggests that they'll be late. How much do you have confidence that they could adjust that stance should some of the soft data start maybe being a little bit more consistent or bleeding into, on the margins, certain hard data points?
I think the way I looked at it was that I saw this as a Fed chair who actually is concerned about the economy. Like reading between the lines, I thought they were concerned about a bit of weakness going on, but they haven't got the evidence yet on the hard data to react to it. And I think what actually is quite clear is they just don't know, and none of us actually know exactly what's going to happen. They're in a really tough spot at the moment. And you think back to 2023, we had the head fake of the soft data there showing signs of weakness, and it never fed through. So they're probably a bit mindful of that. But ultimately, if you do start to see hard data roll over, and it does typically take a few months, I do think they're going to react. So it's probably going to be more later this year that will be happening.
I understand why the front end of the yield curve rallied. I understand why people started to believe that maybe this Fed would respond to weakness in the economy. Why did that trickle into the long end of the yield curve? Why did people buy the idea that not only is this transitory, but the entire international story that we've been talking about of a relevering in Germany and in China wouldn't suddenly be relevant anymore because the Fed's cutting rates? Why is that sort of the logical conclusion?
But I think he made it pretty clear. They were going to focus on the growth aspect of things. He sort of dismissed all the questions around inflation. And if they were concerned around inflation, maybe that's the back end has to move a little bit higher. But if he's going to look through all of that, and then you've got the asymmetry where he talked about we're either on hold or we're cutting, that probably gives confidence to the bond market.
So this is basically the market believing him. This is the market getting back on team transitory. The market is getting back in the team transitory band. Is that what you're saying?
And I think that's right, because that's what happened in 2018. The last time we did transitory was the pandemic, and yes, that was wrong. But if you think about the pandemic, the difference there is we had positive growth and positive inflation. If you're having an environment of negative growth or a slowing in growth, then the inflation, we should be looking through that, particularly if it's a one hit from tariffs, and particularly if you start to see weakness in the labour market, because that ultimately will bring inflation down.
Powell referred to the tariffs yesterday as being tariff inflation, different from regular inflation. How do you decipher between the two?
I think it's difficult, and I think he actually said it's going to be difficult for us to exactly calculate what is tariff and what is just regular. And the problem, and the slight nuance that we've got relative to 2018, we obviously went into 2018 and inflation was below target. It's not at the moment. So again, that's something they just have to be mindful of over the coming months as they think about what they're going to be doing, because inflation was just at a worse place to start with.
Just to pick up on Lisa's line of questioning, let's sit on the markets a little bit more. Perfectly intuitive. Fed cuts rates, see a rally at the front end, got that, yields drop. That's what happened yesterday. Help me understand what happens to risk if the Fed is cutting because growth is deteriorating but inflation is still above target. How does high yield credit trade in that world?
So, like high yield credit, obviously, it's widened a little bit because of the growth. I think it depends how deeply we think these growth impacts are going to be. And again, that goes back to the problem that we've got, that Jerome Powell's got, is we just don't know. We don't know what's going to happen exactly on April the 2nd. We don't know how long this is all going on for. It's a very difficult argument. I think what we can say, though, is going into this, corporates were in really good position. They're very healthy, fundamentally looked very sound. And I think that's what you have to step back and think about. And yes, if you see a real deterioration in growth, of course we're going to see some widening in credit spreads. But I still think there's this all-in yield argument that we've talked about a lot. You know, people like 7.5%. There's no question about that.
Saw that throughout the end of last year as well, coming into 2025. Let's just finish on this. Economic data later this morning, 8:30 Eastern time, we get US jobless claims. This feeling yesterday that the Federal Reserve and Chairman Powell reduced the importance of the soft data. I wouldn't say dismissed it, but we've said repeatedly through this hour, perhaps downplayed it. How important is the hard data going to be? Do we put additional weight on things like jobless claims? How do we trade on that information?
I think the hard data is really important, and I think actually the jobs market is probably the thing we really need to focus on, because if you do start to see weakness there, it's going to filter through to the rest of the economy. So hard data, jobs market, that's what we really need to be looking at.
More hard data a little bit later this morning. Ian Staley of JP Morgan. Ian, thank you, sir. Jobless claims, 8:30, Lisa, the one to watch.
If you get some sort of significant uptick, how much do markets really respond to that? And what is the response? Is it the belief now in a Fed put? Is it a belief that bad news is bad news? I am so confused, because I go back to Stuart Kaiser. You look at a stagflationary mix and risk assets rally the most for any Fed day going back to July. Go figure.
He's confused. He's not alone. Up next on the program, Evan Brown of UBS, Monica Guerra of Morgan Stanley, Mike Pyle of BlackRock, and the former Kansas City Fed President, Thomas Hoenig. All of that and more in the second hour of Bloomberg Surveillance. That's just around the corner.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
What about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be not so big. 3D printing turns out to be not so big. My estimate is $100 trillion was invested in today's dollar in the PC, CPU-based infrastructure. All this is going to get ripped out to put $100 trillion or more in our GPU-based infrastructure. In that sort of quantum of numbers, I feel that the quantum computing is going to be very small.
You always are worried about, I presume, geopolitical events. So are there some geopolitical events you're worried about right now?
Yes. I don't know why, but for some reason, I love thinking about black swans. And at the office, everybody thinks I'm weird because I'm always thinking about what can go wrong. But underpinning the AI is the chips. And the chips, despite the CHIP Act, which I think was a good idea for the US, I still think like 80% or so of the capex of TSM is in Taiwan. And so at the leading edge, a lot of capacity is in one very small area. Forget that it's just in China, it's in a very small area. I think that's very risky.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything. Bloomberg has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers.
Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
The Fed is in a tough spot. They find themselves in the middle of an escalating trade war.
They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy.
This just makes the growth backdrop all the more critical. That really has to hold up for risk assets to validate this move.
All they've told us is we don't know what's going to happen, and essentially, therefore, we are frozen where we are.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and we start with your scores. Equity futures declining this morning, taking a bite out of yesterday's big post-Fed rally. Equities down by 0.5% on the S&P, and the Nasdaq 100 down by close to 0.75%. We get more economic data a little bit later, 8:30 Eastern time for U.S. jobless claims. The soft data, how dependable is the survey data? How important is the hard data now?
Well, right now we're hearing that University of Michigan is one outlier survey that no longer matters to the Fed, and it never really mattered to the Fed. And so in 2022, when you thought that it did, you were making it up. That's at least from Fed Chair Jay Powell's point of view. Look, if you get initial jobless claims tick up materially, how much does that re-engage the idea of the Fed cutting rates more quickly? That's one aspect of this. And then the other aspect is how much does that support risk assets at a time when you actually have slowing growth, and that could potentially be pernicious to the outlook for the United States?
I thought the T word was retired. I thought we got past that. I thought I was toxic in the halls of the Federal Reserve, but apparently not. It was implied by the forecast. If you open up the SCP, you can see it. A bump to inflation in 25, and then if you look at 26, 27, compare the forecast to where they were in December, exactly the same, no change. For this Federal Reserve, they're prepared to look through it.
They're prepared to look through it. Jay Powell called it yesterday tariff inflation, different from the regular inflation they've been trying to quell, using the same terminology that Scott Bessent, the Treasury Secretary, has been saying when it comes to tariff. They're transitory. Maybe they could have used a different word, brief, fleeting, evanescent, but they're transitory, and that the Fed should be looking through them if they want to have any credibility. This is what the Treasury Secretary said, and this is what Jay Powell said yesterday.
A dovish interpretation of Chairman Powell. Difficult not to have one in the news conference. I wonder how many other people on the committee share that view. If you look at the distribution of dots, if you really, really want to get into this, there's a hawkish skew relative to where we were in December. So when we get the Fed speak over the next couple of weeks, I think it could be very interesting to see how much daylight there is between certain officials and what we heard yesterday from the Federal Reserve.
Yeah, just how cohesive is that team transitory? Is it truly encompassing all of the Fed members, or is it a couple of key members at the very top who are happy to be having lunch with Scott Bessent? Look, I think that there is a real question here. I also think there's a great deal of uncertainty, and we have to keep coming back to this, that when someone asked him about the dots and why they didn't move based on some of the different forecasts, he said, well, what did you write down? I mean, what am I supposed to do? This isn't such an easy time. You come and do this.
I can't stand it when they do that. I've got to be honest with you. There was an arrogant tilt to some of the delivery that I saw yesterday. I have to say, we've got to call balls and strikes. I call it as it is. There was a sense of arrogance there. It's not their job. It's not the journalist's job to put out the forecast. It's the Federal Reserve's. It's why they can go out in several years' time and commission $800,000 for a speech. They have to make a forecast.
Putting aside arrogance, there is this point where they're telling you they don't have a clue. And I think that that is something that becomes very difficult for markets to know what to do with, because as much as we're trying to glean a reaction function, how dependable is it, when ultimately the data could really profoundly change?
Deep breath, I'll settle down. Should have slept more.
Evanescence.
Yeah, she got out the thesaurus, didn't she?
I love this.
I know.
I'm sorry, but transitory evidence, no, an evanescent inflation.
Then call it fleeting or brief. We've already went through a transitory environment that many would say, like Mohammed Al-Arian, was a mistake for this.
This hour's going to be special. Equities right now in the S&P, down by 0.5%. Coming up this hour, Evan Brown of UBS Asset Management following a Fed-fueled relief rally. Monica Guerra of Morgan Stanley with President Trump saying the FOMC should cut interest rates, and Mike Powell of BlackRock on why U.S. recession risks are overblown. We begin this hour with futures negative despite stocks seeing their best Fed day since July. Evan Brown of UBS Asset Management writing, Powell did what he needed to do, which was to keep a low profile and wait for more clarity on Trump's tariff agenda before sending a strong message on rates. Evan joins us now for more. Evan, good morning. Good to see you.
Good to see you, John.
As a fiery open to this hour, forgive us. Your interpretation of yesterday. Let's start there.
Yeah, well, I think Lisa nailed it by saying the Fed doesn't have a clue. None of us have a clue. We're waiting for April 2nd and the big tariff news, and it was the Fed's job to just say, okay, with the tariffs already in place, here's how our forecast has adjusted. But other than that, just do as little damage as possible. Don't pre-commit yourself to anything, because we just need to see what's going to come out on April 2nd. And so I think, you see the shift in the dots, you see the shift in the forecast, but really I think Powell gave a good press conference in which he probably used the word uncertainty 1,000 times. And that's the reality.
Because things are very uncertain, so you can't put too much weight on the forecast. But I do think this is an important exercise to learn something about the reaction function. How would they respond to certain scenarios? Do you have a degree of confidence that if we do get a deterioration in the hard data, if it follows the soft data lower, that they're able to respond by cutting interest rates?
Yes, strong conviction that's the case. We're very much of the view that, and I think Powell essentially shared this, that they seem more concerned, I shouldn't say they, Powell seems more concerned about the downside risk to growth. And that's our view too, is ultimately you get this one-off shock in inflation. That's going to weigh on real incomes. It's going to weigh on business hiring decisions and CapEx decisions. And ultimately, the Fed, once they just start seeing a hint of that hard data weakness, they'll be more inclined to cut. That's what we saw in 2018, 2019. Even though inflation is more elevated, I think that's the bias of the Fed, and I think that's the right one.
Which is the reason why I understand the reaction of Treasuries rallying at the front end. I really don't understand the long end. Basically, the market that previously had concepts of inflation being stickier and possibly even reaccelerating over the long term heard the transitory word, said, you got it, all right, we're in, and we're going to buy Treasuries. At what point is the fact that the Fed is going to cutting rates in the face of weakness potentially increase the risk of longer-term inflation becoming stickier, more entrenched?
It could. It's difficult. I mean, there's a lot of things going on with the long end right now. You've still got concerns about the budget deficit. You've still got concerns about what's happening with a rise in rates around the world, particularly in Europe, and so that putting some upward pressure there. So I think you are going to see. We have more conviction that you'll see more of the action at the front end of the curve as the Fed shifts.
So is that what you're talking about when you say Treasuries remain a good hedge for risk assets? That it's really cash-like Treasuries?
Yeah,
not necessarily long end.
Closer to the front end, yeah, that's our view.
What do you make of the rise that we've seen in gold? The fact that it hit a record high yesterday after the press conference, at the same time you did get some sort of rally in risk assets.
Yeah, I just think gold is, it's the perfect manifestation of policy uncertainty. I mean, yes, we've got what we all know is the steady accumulation by central banks around the world that are providing some kind of support there. But really, the one hedge for kind of I don't love using the word stagflationary because I think it exaggerates the situation that we're in, but an environment where you have slower growth and where you have stickier inflation, gold has proven to be the most dependable hedge in that scenario. And gold just continuing to rise in this environment reflects still that growing uncertainty and reflecting an uncertain Fed yesterday.
Do you think you'll be less uncertain after 13 days after April 2nd?
That's the thing. We would hope so, but we really don't know. We'll get a lot of announcements, but how much is the administration going to implement tariffs right away versus say, okay, we're going to have this review period and we're going to leave time for negotiation? How much of it is going to be based on these reciprocal tariffs being based on tariffs versus non-tariff barriers? And the reality is, it does not seem like the U.S. Trade Representative is adequately staffed up for the complexity of all the things that they're going to need to do to actually make reciprocal tariffs work. So my concern is that we go and we have this event and a lot of the tariffs are announced, but we don't know what's actually really on and what's not, and it's going to take time, and that's going to prolong that uncertainty for businesses. Which I think is another reason why we kind of lean into bonds. Is I think these headwinds are going to stick with us for a good part of the year.
If we're more uncertain even after April 2nd, and there's basically businesses saying they're going to be on pause, then would you view the Fed as really leaning into the fact that they're concerned about growth and less about inflation?
Yeah, I think so. I mean, look, we're talking about soft versus hard data. I do think you're going to need to see some weakening of the hard data beyond what we've seen so far. It's been very modest to get the Fed really moving.
Will they then be behind the curve, though?
They could end up being like a meeting or two late, but I think in the end of the day, if they're a meeting or two late, that means they're doing 50 basis point cuts later this year if things are getting really bad.
Want to congratulate you. You were early on pro-China and talking about the China trade and international trade. I'm just wondering whether you're closing that out, whether you think that that's basically had its run, and now you're starting to pick up the pieces in bonds and gold.
Yeah, so we've had bonds this year. We've had gold for a good part of the last year, and then we've had this international exposure in China and Europe, and that fortunately has worked out well. I think the speed of the move at this point is getting us to say, okay, it's time for a little bit of a break. I mean, you look at European banks, they're trading like a meme stock right now. It's like 35% up year to date. And
can you translate taking a break? What does that mean?
What I would say is, some consolidation. We kind of move sideways a little bit, and would not be surprised at all with with tech and Mag 7, which have taken an absolute beating, if we get a little bit of rotation back into there, over the next few months. But I do think the structural theme is going to be more towards allocators moving, away from the U.S. and just seeing better opportunities. Look at Germany. We've been waiting for this fiscal stimulus to get unleashed for a long, long time.
Decades.
It's finally done. I think that theme has something to run. And so, we expect over the course of the year and coming years, more allocation into international markets, getting a lot of questions about it from clients. I think U.S. investors have a very, very long home bias. And it's been a wake-up call over the last few weeks. And so, I think you'll see more allocations into international.
I know how that pitch has gone for strategists for the best part of a decade. They say you need to diversify, you need to buy international, and they just go, oh, yeah, whatever. I think that's started to change over the last few months.
Yeah, that's what we heard yesterday. And we were talking about how there's nothing better for an advertisement, an educating lesson than saying, look, it's trading like a meme stock. You might want to get in.
Evan Brown. Good to see you, sir, as always. Thanks for being with us. Evan Brown of UBS Asset Management. Plenty of feedback on the Fed decision yesterday. Appreciate all the incoming emails. This from Kit Jukes of SocGen. Central banks are flying in the fog without a radar. That seems to be how you feel this morning.
Well, yeah, and it's really frustrating because it's hard to say anything particularly insightful about flying in the fog with blinders on, and that's essentially what they're telling us. So at this point, how can we understand what the reaction function is? And I'll add to this. Who's going to be at the head of the Federal Reserve by the beginning of next year at a time when potentially they're facing a pretty complicated mix of data?
Is that a question? Because I can't answer it.
Okay, who?
I can try. I can tell you who'd like to be.
Okay.
He's the guy who dissented.
Right. Yes, about the balance sheet. Yeah. So this just raises a question. What is his name rhymes with Solar?
I think we could just say it. Governor Waller's put a bit of daylight between himself and the committee. And Governor Waller's been able to stick his neck out on a few occasions. And we saw that with tariffs, by the way. So he was the first one to come out and say, I don't think this tariff policy issue is going to be inflationary. And then you saw the rest of the committee start to follow, based on the communication we got from Chairman Powell just yesterday.
Yeah, it just raises another layer of uncertainty. If there isn't going to be continuity at the leadership of the Fed, can we really rely on a reaction function for being longer lasting than, say, the remainder of this year?
And once Bowman got Barr's job, Waller was nominated by President Trump in a first term. That's got to be the favourite right now. It's got to be the favourite right now.
Housewives of Washington.
We'll see. These things can change. Equities at the moment softer. We're down by 0.4% on the S&P. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Yahara Heckes. Hey, Yahara.
Hi, John. India will be included in President Trump's reciprocal tariffs slated to take effect on April 2nd. In an interview with Breitbart, Trump said the country is, quote, one of the highest tariffing nations in the world. To try and avoid tariffs, India had lowered duties on imports of some American-made products and even agreed to buy more energy and weapons from the U.S. Meanwhile, NVIDIA is reportedly planning to invest hundreds of billions of dollars in U.S.-made chips and electronics. The Financial Times reporting NVIDIA will spend about $500 billion in the U.S. over the next 4 years. CEO Jensen Huang telling the FT NVIDIA can manufacture its latest systems in the U.S. through suppliers like TSMC and Foxconn. And copper prices topped $10,000 a ton earlier. They are now a bit lower. The rally comes after President Trump ordered the Commerce Department to investigate U.S. imports of the industrial metal last month as a likely precursor to imposing levies. Since then, U.S. prices have spiked and traders have scrambled to send the metal to America ahead of any tariffs. That's your Bloomberg brief. John?
Hey, Yahara, thank you. Tariffs front and centre. This data point out of Canada just moments ago. Small business optimism in that country collapsing to a 25-year low. Just some of the data points you're seeing in response to the policy changes.
Yeah, Canadians care. They care a lot. And this has become a real issue. And we've heard that from the Bank of Canada themselves, saying that we cannot see exactly how we're going to progress because of uncertainty. And we heard the same thing from the Riksbank and the SNB overnight.
Another data point, if you are just joining us, small business optimism in Canada collapsing to a 25-year low. Up next on the programme, same question, same answer.
President Trump fired 2 members of the Federal Trade Commission. If those firings stand, is that a threat to the Fed's independence?
So I think I did answer that question in this very room some time ago.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Nope. Monica Guerra of Morgan Stanley joins us next. Live from New York City this morning. Good morning.
Brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
So A softer session today. Equities down in Europe on the DAX were lower by 1.4%. No positive follow-through over in the United States either. Here stateside, equities softer. We're down by 0.4%. On the Nasdaq 100, we're down by 0.5%. Under surveillance this morning, same question, same answer.
If those firings stand, is that a threat to the Fed's independence?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
You've got to always have a follow-up question ready for these guys, just in case they go short. It's like a nightmare for any journalist. Like, no, oh no, what do I ask now?
I actually feel for her, and frankly, they're like, I could completely
Can you
relate
expand upon the no?
Yeah.
No.
He played that game yesterday in the news conference too, a few times, with various questions. Fed Chair Jay Powell reiterating he's not concerned about President Trump's threats to Fed independence. Trump pressing the Fed to cut interest rates later on in a post on Truth Social last night, to cut interest rates and embrace Liberation Day on April 2nd. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, we talked about this briefly. Just how much daylight is there between the Federal Reserve and the White House?
Well, John, at this point, it appears that they are on the same page when it comes to there being a potential short-term inflation bump due to tariffs. And Jerome Powell saying yesterday that he does believe that those long-term inflation expectations are well anchored. However, when it comes to the growth forecast, it does appear that this White House is taking some issue with that. Kevin Hassett yesterday telling reporters that his forecast is 2.5% GDP growth for this year, of course, differing with what we saw from those FOMC projections. Now, just to go back to the bite that you played at the top there, we should note that while President Trump has previously criticized Jerome Powell, particularly back in November, heavy criticism about how the Fed was cutting rates close to the election, he has said that he does intend to let Powell serve out his term. And we have heard from this White House that they do respect the Fed's independence, going back to Kevin Hassett yesterday, who, by the way, last month did reveal that he was having regular meetings with Jerome Powell. He says that at this point he has no intention to cherry pick the Fed chair's statements.
Hey, Tyler, appreciate the update. As always, Tyler Kendall there in Washington, D.C. With us around the table to extend the conversation, Monica Guerra of Morgan Stanley. Monica, good morning to you. Let's go to the president's post on social media yesterday. Liberation Day is April 2nd. How are you describing April 2nd for clients? What's going to change? What's going to remain the same?
I think it's going to be, a will you or won't you moment. We're essentially have to take the lead from Lutnick. And what he's made clear is that all of these reciprocal tariffs, could either go into effect or not. And that's sort of the big driver, right, of all this policy uncertainty. And so we're trying to sort through that with our clients and essentially keep them really focused right on those long-term, investing goals, et cetera, but also try to look through potential tariff risk and highlight different industries and sectors that could be insulated from potential changes.
So what industries, sectors, and countries specifically are you focused on?
I mean, we're looking obviously at China. How far can they go with China, I think, is the question right now. People forget that under the Biden administration that he kept ratcheting up tariffs with China. And so, yes, these are new tariffs with Trump, but it is an extension of that 2018 policy. So how far can you go there? Look to see what's happening with India. Obviously, Mexico and Canada, we think that there's, less of a risk for long-term tariff ramifications there just because of how closely our supply chains are integrated. But when you're thinking about industries that are insulated, it's utilities, real estate, financials in some cases. And so for us, those are the areas that we're looking at. And some of those areas are actually also beneficiaries of potential deregulatory policy. So once we actually move past downsizing, cuts, tariffs, all of this, austerity, I think the narrative will eventually change.
You mentioned India, and the president mentioned India yesterday in this interview with Breitbart, and he said they're going to probably be lowering those tariffs substantially. On April 2nd, we'll be charging them the same tariffs they charge us. Do you see this period right now as the negotiation? Because Kevin Hassett said he's working with Commerce Secretary Lutnick, Treasury Secretary Bessent, now with countries to try to see if reciprocity could be reached.
Yeah, that's what essentially that's what they're doing over this period. They gave us that April 2nd deadline, and we'll have more news, right? More shall be revealed on that day. The thing that for me, when I'm thinking about Fiscal policy and budget, what people forget is that they're planning to use tariffs as a big offset. And I've talked about that on here before, but what that means is that there is going to have to be some certainty before they get a budget across the line. So when I'm talking to clients and thinking about market volatility as it relates to policy uncertainty, we do think that that'll likely continue through the summer, but that August through that October period where they have to get things locked up, they're going to have to make hard decisions and account for where the tariffs are actually going to be levied. And so we'll have more certainty then.
This is something that Tom Becker of BlackRock raised, this idea that people think that the U.S. is practicing fiscal restraint right now, but that's not actually what's going to happen. And later this year, you could actually see fiscal expansion, and we're just seeing the offsets to what that could look like later on. Do you agree with that? Are we going to actually still see fiscal expansion in the United States at the same time that we get fiscal expansion in Germany and fiscal expansion in China? Everyone's exceptional in a new fiscal expansionary world?
I think that you get fiscal expansion in 2026. So if you're thinking about legislation and what can get done this year, it's all about that budget bill. So it is going to be a restrictive policy. Now, at the same time, where you get growth is from that deregulation activity that's happening in the background. So those two things are going to offset each other, but it doesn't necessarily mean the same type of fiscal, expansion, the fiscal tailwinds that we've seen. 2026 is when I think, I keep saying, they're going to turn the spigot back on, because what is the job of Congress? Is to manage interstate commerce, look at the tax code, and spend. And so that is what they're going to go back to, right, is what they do best, right? And that's what they do under any administration. And so this is a point in time moment, and then we're going to go back to business as usual.
Based on the debt pile, what they do best is spend and spend a lot. And then a whole lot more. Monica Guerra of Morgan Stanley. Monica, it's good to see you, as always. Surprise coming into 2025 wasn't US policy. It was how everyone else was planning to respond to it. We started to see that from Europe. I think we've got to ask more questions about how Canada is going to respond to this as well. So the Globe and Mail reporting today that the Prime Minister Mark Carney is set to call a snap election, a snap federal election, on Sunday for an expected vote on April 28th. We'll see if we get a final decision from the Prime Minister later on over the next several days. But it's interesting to see how the data is already turning in places like Canada. I mentioned this briefly if you are just joining us. Small business confidence dropping to a 25-year low in that country, pushing potentially Canada to respond as well.
Especially at a time when you're talking about 25% tariffs, and you're talking about severing a relationship that has been like a family at a certain time that you don't have a sense of what's going to potentially replace it. You can understand it. So you get a fiscal bazooka there too. Everyone's doing it. Why not?
Not everyone can do what Germany's trying to do. Not everyone has the fiscal space.
Can everyone do it at the same time as well?
With great difficulty potentially for this bond market. Mike Parle of BlackRock on why recession fears are overblown joins us next. From New York, this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Nice rally yesterday. We take some of it back this morning. Equity futures negative by 0.5% on the S&P. On the Nasdaq 100, lower by about 2/3% on the S&P 500. 2 hours until the opening bell. Let's get you some morning movers. Here's Yahara Hacker. Say, Yahara.
Hi, John. We start with Stellantis falling 3.7% here in the pre-market. This is after its chairman said tariffs are a risk to its future car production plans in Italy, even as the company makes big investments there. But also weighing on this stock is a downgrade by the team over at Piper Sandler. The analyst is warning that all automakers except for Tesla should be avoided. Next up, we have Five Below shares. Those are soaring here in the pre-market, up nearly 10% after the discount retailer issued a better than expected outlook. It's interesting to see it rising so much because the company did say it expects tariffs to weigh on margins. That's because 60% of its products come from China, but they say they are trying to mitigate this by raising prices, but of course, keeping them below $5. And last up, we have Darden Restaurants. Those shares are falling slightly, about 0.6% after the company behind Olive Garden just reported results. Third quarter sales missed estimates, and looking ahead, it maintained its guidance. Of course, it'll be interesting to hear what executives have to say on the call about the consumer, since we did see restaurant spending fall in the latest retail sales report. John?
It was a soft part of the report, that's for sure. Yahara, thank you. More from Yahara later on this morning. On our radar this morning, President Trump saying the Federal Reserve should cut interest rates as he prepares for a fresh wave of tariffs, posting on Truth Social, quote, the Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy.
You know, normally, I remember a couple months ago, if President Trump had messaged this before he was inaugurated, people would have gotten very concerned and said, oh my gosh, he's questioning the independence of the Federal Reserve. It seems like there's been a bit of a coming together, frankly, of Fed Chair Jay Powell and certainly Treasury Secretary Scott Bessent. And a lot of what Fed Chair Powell said yesterday can't be that offensive to what the White House is saying. So even though he put this out there, I don't feel a lot of outrage on Wall Street, you know, saying, oh my God, this is going to
because you're desensitized.
Exactly. You think so? It was only a matter of time. He said that he thinks he knows, has a better feel of where rates should go. He's a real estate guy than even the Fed. He's like, I know I can't dictate the policy, but I certainly have an opinion, and I'm going to share it. And that's what he did. He shared his opinion. I would say if the president's watching this morning, maybe the Fed could cut rates when he has more certainty on where policy is going. And for that, we need to wait 13 days for what he is calling, quote, Liberation Day in America.
I am desensitized. Isn't that the point?
Everyone is.
That's kind of the point of this whole thing, no?
We've heard it so many times that it just doesn't carry the same weight that it used to. People used to freak out about this in the first term, and now it's just like, yeah, here we go again.
People used to freak out about a lot of things, and now people are just sort of like, yeah.
I was more surprised about how late it came. Like, I woke up to that, and I went to bed thinking, weird, we didn't hear from the president.
You were expecting a live blog in the news conference. I think we all were. Equity futures right now just a little bit softer. More on the Fed in just a moment. I want to get an update on foreign policy. President Trump telling Iran's supreme leader he has 2 months to reach a new nuclear accord. Sources telling us here at Bloomberg, Trump laid out the deadline in a recently delivered letter as he increases pressure on Tehran.
This is a story I had yesterday, this letter that went via the UAE to Tehran. Trump is saying, you have 2 months. This is a carrot and stick approach. There's an overture saying maybe we can make a deal. At the same time, we see maximum pressure coming back on Iran, potentially even more sanctions, but also we see what's going on with the Houthis. Basically, the message to Iran is stop with not just nuclear, but also the money that you are funding to proxies like Lebanese Hezbollah, Hamas, and the Houthis.
That's the latest on foreign policy. Elsewhere, the White House is considering extending Chevron's license to pump oil in Venezuela, reversing a recent push to have the company wind down operations. The Wall Street Journal reporting the U.S. will still impose penalties on other countries doing business there. Mike Worth of Chevron was in the building, in the studio with us a number of weeks ago. We talked to him about this. This was always going to be on the radar of this administration.
It sounds like he's been spending a lot of time in Washington, D.C., lobbying them to explain that if Chevron gets out, guess who gets in? China. Guess who ends up buying some of this oil? And it creates this real pressure. If you do want to create some sort of isolation and to have a geopolitical negotiating tool, how do you do it in a way that doesn't advantage some of your potential opponents in other potential strategic ways? And this has been something that has been an ongoing challenge.
That's the latest reporting from the Journal. Let's turn back to the markets. Stocks just had their best Fed day since July after Fed Chair Jay Powell says tariffs' impact on inflation might be transitory. Mike Powell of BlackRock writing, while negative stock-bond correlation has re-emerged, we do not believe it will persist. With sticky inflation, tariffs and significant U.S. fiscal deficits, the Fed faces challenges and term premia will come under pressure. Mike joins us now. He's also the former economic advisor to President Joe Biden. It's good to see you, Mike, as
good
always.
To see you.
Should we start there? How does it feel? Does it feel good? Have you shaken the Washington, D.C. off? Do you feel better about it?
I've got a spring in my step. Happy to be back in New York and happy to be with you.
We can get into the markets in just a moment. I'd love your assessment of where the economy is and how these policy changes might influence where the economy goes in the coming quarters.
Yeah, I mean, certainly I think we're in the midst of a pretty significant set of shocks. So obviously trade policy uncertainty, both the magnitude of it and the uncertainty around it. Certainly, I think some slowdowns more broadly in the data. The flip side is, the United States is a very dynamic, very resilient economy. And I think what you heard from the Fed yesterday is, while these shocks are significant, while growth is likely to come down, while inflation in the short term is likely to move higher, still there's a kind of underlying strength there that's going to see growth through.
When it comes to tariffs, all the players. Obviously, we're not in the Trump administration, but you know who they're dealing with on the other side. Do you think we get to a place where it's methodical reciprocity?
So I think what we've seen from other countries is, a likelihood that, this negotiation is going to play out in the backdrop of not just tariff announcements from the United States, but threats of retaliation from others. And I think that, I think one of the big questions as we roll the clock forward over the next 3, 4, 5, 6 months is, not just where do U.S. tariff levels end up, but where do other countries end up with their tariff levels? To the extent that, deals are possible, negotiations can reach some kind of resolution that ends up with tariffs perhaps lower than what gets announced on April 2nd on both sides. I think that's going to be ultimately a world that's healthier for growth and inflation globally. I also think at a minimum, as we roll the clock forward, we're going to get more certainty, and that's going to take some of that uncertainty discount off of economic forecasts as well as markets.
But if there's this reciprocal tariffs and then there's the hit back, the tit for tat, do you think there's a chance you can tip the United States into a recession? Powell said it's moved up, but it's off the table for now.
Yeah, like I said, I would just echo, Chair Powell. The shocks that we've seen are significant. We're going to see significant shocks. That's going to lower growth. That's going to mean, at least in the short term, higher inflation. But, that the underlying momentum, the underlying dynamism, the underlying strength of the U.S. economy is, quite significant. And that's hard to turn around.
You might agree with the Fed on that front. I get the sense you're not exactly joining the band yet of transitory. You're kind of on the sidelines saying, I'm not sure that that's actually the case. And you made a point about you're not totally buying the long end rally that we're seeing in treasuries. Can you talk a little bit about what you're seeing that makes you disagree with the Fed's assessment that we can resurrect this word transitory?
Yeah, so I think that, that when you look at the long end of the U.S. curve, I mean, yes, we've seen a rally over the past couple of weeks as these growth scares have worked their way into the market. But looking out over the medium term, inflation does look somewhat stickier. And obviously, we're going to have a shock on that in the short term. I think fiscal deficits are likely to be persistently high. And, when you face a backdrop like that, I think you do see pressure on term premium built up, particularly from the starting point we're at today. And that means that bonds are going to be less strong as diversifiers kind of rolling ahead as they have in the last 2 or 3 weeks and as they were, during the 2010s. That means that investors are going to have to seek diversification in other places, whether that's managing fixed income in different ways or seeking uncorrelated sources of return that can provide that diversification.
Where do they find those uncorrelated sources of return? And I'm so pleased you've brought up this topic because I've lost count of how many times we've asked this question over the last few weeks or so, haven't we? We've gone back and forth on this. Are we seeing a reduction in risk mitigation characteristics of treasuries? Over the last few weeks, I think slowly you've started to see some evidence of that.
Gold. I keep thinking gold. Are we just going to gold? And is that the reason why you see it keeping on rallying?
Yeah, I mean, I think that exactly to your point, John, I mean, obviously at the beginning stages of the pullback, you saw really strong reactions from the Treasury market. That's diminished as we've gotten kind of deeper into this period of volatility. I think that's a harbinger of what's to come. I mean, at BlackRock, one of the things that we would say is you should, seek diversification from things like stable long-term cash flows that are less growth sensitive, that are more inflation sensitive, places like infrastructure. The thing that we really look at are things like, our quantitative multi-strategy hedge fund, built on the back of 40 years of innovation and leadership. They've come through this period generating solid alpha. And what it proves out is, having a range of different strategies, a range of different ways of generating alpha. And in this environment in particular, what's worked is, strategies that are primed in market reversal periods, strategies that provide liquidity to segments of the market across asset classes that can generate alpha even in the face of market dislocation. And that's what investors are looking for.
John, that's not nearly as sexy as gold. Multi-asset, diversification, steady cash flows.
Well, they've got things to sell here, Lisa, not just gold bars.
I know, exactly.
Private markets, infrastructure funds, all of those kind of things. I'm not throwing shade. Total respect for the position. The answer used to be bonds, used to be German bonds. And obviously that's not the answer anymore. How have things changed in Europe from your perspective?
Yeah, so I think it's actually a really interesting moment in Europe. I think the debate within the firm is this a trade or is this a more durable investment? On one hand, obviously, Europe, Germany has stepped forward with a set of fiscal policy changes that, as far back as when I was in the Obama administration, we were calling for. That is really tremendous to see. But I think that among the bellwethers that we're looking for is this going to be coupled by changes in the regulatory environment? The Draghi report talked a lot about the degree to which Europe remains uncompetitive in the technology sector, the types of spaces that really drive innovation and growth. If we see a turning of the page there, that might be, a precursor for a much more durable European trade over the long term and take it from just a 3-month, 6-month trade to something much more long-lasting.
I'm sitting here smiling. I've known you a while. It's nice to hear you talk about markets again. It's been too long. It's nice to have you back in this seat. I want to finish where we started. How are we going to make sure that talented individuals keep going down to Washington, D.C. to do the kind of work that you did, that Dalip Singh did, that Wally Adeyemo did? How are we going to make sure that continues?
So, I think when I look across, a number of friends that I've had who've served not just in, Democratic administrations, but Republican ones. I think to folks like, Justin Muzinich, who was the #2 at the Treasury Department in the first Trump administration. I look into this one and see, really thoughtful, qualified people as well in important pockets of that administration. I think that the call to service is a strong one and the call to deliver for the country is a strong one. And I expect that we're going to continue to see that across administrations of both parties.
I hope that remains the case. Mike, it's good to see you. Mike Powell there of BlackRock. We've talked about this before. Really talented individuals that we see on both sides of the aisle. In this administration with President Trump, we spoke to Secretary Bessent about that. In the previous administration as well. That's what you want to see. You want to see the best of America still going down to Washington, D.C. And I hope that remains the same.
I'm smiling because that sounded like you're running. No, I'm kidding. I'm not going to do that to you. I'm just thinking to myself, though, that is what I've heard from a lot of people, that the call to service is one that you answer. And you do just hope that that continues through the years, especially through the turmoil.
Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackett. Hey, Yahara.
Hi, John. Hamas says talks with mediators to halt Israel's ground incursion in the Gaza Strip are ongoing. The operation is seen as a response to Hamas's refusal to release the 59 remaining hostages. This comes as Israeli Prime Minister Benjamin Netanyahu says a larger front of the war could open up in the West Bank. Meanwhile, the Ontario Teachers Pension Plan is shutting down its Hong Kong office. Sources telling Bloomberg it's trying to reduce its China exposure amid rising geopolitical tensions. In a statement, the fund said its Hong Kong office will be wound down over the coming 18 months without giving a specific reason. And California Governor Gavin Newsom has been mailing cell phones to CEOs of the top 100 California-based companies with his phone number programmed into the contacts. Newsom's office said he's been doing this since November in an effort to connect more directly with business leaders in the state. That's one way to do it. That's Bloomberg Brief. John?
Yahira, is that story for real? That is absolutely unbelievable. More from Yahira a little bit later. Did you hear that?
Yeah, I don't know why you would need to send CEOs
A
cell
phone
phones.
with your cell phone number in already.
But you're the governor, so everyone should be taking your call, no? Unless you're too busy maybe doing a podcast.
Which he's been very busy doing, which I've listened to, which wasn't too bad, to be honest with you. I know a lot of people have criticised it, but I don't think it was too bad. The one with Charlie Kirk was the first one, right?
That was the first one. I've seen rollouts of it on Twitter, the second hand that made it Twitter, but
It's
I'm
like
not
watching him slowly become conservative in that first one. Anyway, all
He was
right.
convinced by the end of it that he was almost
Very quickly he was.
agreeing with Charlie Kirk.
Up next on the programme, Team Transitory gets the band back together.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored.
Up next on the programme, we'll catch up with the former Kansas City Fed President Thomas Hoenig. From New York City, this is Bloomberg.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Versace in Davos, Switzerland, and this is Bloomberg.
So here's the state of play. Just a little bit more defensive this morning. Equities negative by 0.4% on the S&P, and bond yields down by 4 basis points. The 10-year getting away and breaking out of that range. The 10-year down to 420 so far this morning. Under surveillance this morning, Team Transitory gets the band back together.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
So here's the latest this morning. The Fed Chair Jay Powell alleviating tariff concerns, saying the levies might only trigger a one-time price hit. We can lean on the expertise and experience now of the former Kansas City Fed President, Thomas Hoenig. Thomas, welcome back to the program, sir. We'd love your assessment of yesterday. It was a 3-part act, the decision, the news conference, and the new projections. How would you summarize things?
Well, I think, number one, yesterday was not a surprise to anyone. Everyone knew that they were going to hold constant given the level of uncertainty. I think also for me, it was not at all surprising that they backed off quantitative tightening, bringing it down from 25 billion to 5 billion a month. And that reflects their concerns about liquidity in the market, given the uncertainties that the tariff brings on, that the fiscal situation brings on. So they did, in fact, ease relative to their quantitative tightening program. And I think that's important because that brings liquidity into the market. So no surprises from my perspective. I think, right now, everyone's talking about the tariffs. That probably is one time, depending on so many things. Whether we really get in a trade war, tariffs trade war, that could extend it and make inflation more difficult. The other thing that no one's talking about that I think is every bit as important is the fiscal situation. Our debt is going to go up again. That's a big deal in my mind relative to what the Fed will do in the future.
So hold on a second. It sounds like, Tom, you don't necessarily buy the idea of transitory inflation on a wholesale level, maybe with respect to tariffs. But on a broader level, you think that it's not quite the same argument that inflation wholesale is as transitory as maybe it otherwise would be without that kind of deficit overhang. Is that correct?
That's what I'm saying. There's a risk here. Number one, think about it. We have huge debts coming forward. If we get through the transitory tariffs, that would be fine. But we're going to spend a lot more money again as a nation. The Fed's going to have a lot of pressure from this administration and from the economy more broadly to monetize some of that and to help the banking industry monetize that debt that's going to be coming on board. That should put inflationary pressures up higher. And number two, remember that they keep saying that policy is restrictive, but real interest rates are in the 1.5% range. That's not particularly restrictive in historical context. So I don't think we should be all that sanguine if we get through this tariff that we're home free. We'll see. I hope we are, but I have some reservations, yes.
It sounds like you disagree on several fronts with some of what the Fed put out yesterday. First of all, the idea that they forecast inflation coming lower after this year, that one-time bump. And then also this idea that going forward, you're going to have slowing growth, but it's not going to be some sort of downturn, that it's going to be sanguine. Do you think that it is setting up for a policy error, that the Fed is looking through inflation as a short-term phenomenon without considering some of the fiscal overhangs that you're talking about?
Well, let me put it this way: they're not talking about those issues. They're focusing in on the tariffs, which everyone is. But monetary policy is supposed to be a long-run process, and you have to think of where you are a year from now, but 2 years from now, and they're projecting everything just comes right back into normal. But I think that they won't talk about the the fiscal problems we have in this nation, that's a big deal. And I think the Federal Reserve will be under pressure. So, I'm not sanguine about the long run at this point, given the absence of discussion about one of the most important things this nation faces, and that is a growing, huge national debt problem.
Last night, the president did tweet that the Fed would be much better off cutting rates as U.S. tariffs start to transition, his words, ease their way into the economy. Does it bother you that this president still takes to social media or talks to the press and tries to dictate what the Fed should do?
Well, I don't know if he's dictating or if that was this is my view. There's nothing wrong with that. Look, everyone has a view about what the Fed should do. I don't have any problem with that. Now, if he forces it and starts threatening it, that's a different story. But I think, and with that in mind, why shouldn't the Fed, I think, be talking about fiscal policy? It makes their job all that much more difficult. So why shouldn't the Fed be saying, Congress, we're worried about the debt. This is an issue. It'll affect our ability to control inflation. Work on that. So I don't. It doesn't bother me that he does it, so long as he doesn't force it down their throat.
Tom, I want to pick up on one point that you put out there where you talked about the pressure to monetize the fiscal deficit down the line should that become untenable. And I just wonder if you actually think that is a likely outcome where essentially as the U.S. deficit becomes larger, in order to offset that and lower longer-term yields, the Federal Reserve will expand their balance sheet once again. You think that's feasible?
Well, I think they'll have pressure to do that, yes. Whether they do it or not, I don't know. But I hope they don't, and it's not feasible, and they make that clear. But think about it. We're going to add $2 trillion more of debt this year. We have to turn over debt. There's going to be upward pressure on interest rates from that, and the Fed will be under a lot of pressure to reduce that. And that's really what has happened over time relative to causing or allowing inflation to break out in this country. Yes.
Hey, Thomas.
Your concern.
Lucky to catch up with you this morning, sir. We appreciate your time. Thanks for being with us. The former Kansas City Fed President Thomas Honig there, leaning on some of his experience at the Federal Reserve to think about where we are for this Federal Reserve in 2025. And Bob Michael at JP Morgan Asset Management, I think, framed it really nicely going into the decision yesterday about how much of a moment this really was for this Federal Reserve. A challenge, the central banker's dilemma when you have downside risk to growth and upside risk to inflation.
Which do they prioritize? And yesterday in the press conference, it seemed like there was more of a focus on downside to growth simply because inflation was transitory. There is a caveat here, and this is something that Thomas just brought up. Is it just inflation tied to tariffs that's transitory, not necessarily some of these other overhangs? The projection seems to suggest it's all inflation, but that's an important thing at a time where you can't really scientifically parse out what's tariff inflation and what's related to some of these other
He acknowledged that, didn't he?
Exactly.
In the news conference. So if you get a bounce later this year, that's going to be an interesting one.
Correct.
He turns around and says, we can look through this, we can respond, but you said it's very difficult to understand what's the difference between the two, so how do you know?
And how do you look through it at a time when previously transitory has turned out to not have been a successful band, at least on the Hot 10 list?
Yeah, it's been very difficult. The band's getting back together.
Yeah, well, let's see if they can stay together.
Great song, isn't it? I wasn't expecting to hear it yesterday, I have to say. I was surprised by that.
The transitory?
Yeah, just throughout the T word.
Let's hear what the beat's like.
It's becoming a big distraction. But maybe that was the intention. Coming up next on the programme, Greg Bowdle of BNP Paribas, Brooke Roach of Goldman Sachs, Luke Tilley of Wilmington Trust, and Matt Brill of Invesco. The third hour of Bloomberg Surveillance. Up next.
In 2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And, in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like this, the speed with